PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Let me say there is bipartisan support for a significant infrastructure package. There was during the Obama administration. There was during the previous administration. It's been challenging to figure out exactly how we can pay for it in a way that's comforting to both sides.
It's been quiet, relatively speaking. That was Senate Minority Leader Mitch McConnell there from New York City this morning. Good morning. Alongside Tom Keene, Lisa Broward, I'm Jonathan Ferro. Tuesday morning is the price action. Coming into Tuesday, sitting pretty at all-time highs on the S&P, down just a single point to 42.79. Outside of that, in the bond market, 148.16 on 10s. JP Morgan sticking with the short. Jay Barry still looking for 195 on a 10-year. Right now, Tom, sub 150.
Yeah, sub 150, and I think the rate market has sort of been quiet here. We get some economic data and on to jobs day, John, but the rate market, I'm waiting for it to tell me something. It really hasn't told me much.
What's it telling you right now? Not much.
It's just not much. It's just not there.
What about the idea that peak everything's behind us? Peak inflation fears are behind us. We're all done with that.
Yeah, it's a theory. You know, where are you on that, John?
Clearly a theory you're not giving much weight to, Tom. Here's the argument from JP Morgan. Valuations are rich. Supply will remain heavy.
Oh, sounds like Lisa.
And the dovish reaction function of the Federal Reserve should allow inflation to increase.
What? Ben Laidler is looking for double-digit equity gain. He's on his way to that. What a call. I mean...
But what a first half.
What a first half. Best in 9 years, and that's where we are. What a first half for the Biden administration as well. Maybe it's a mark for them, even though it all started later in January and not January 1. Anne-Marie Horton is in Washington to give us an update as well. Anne-Marie, just simply, what is the power of the left on a Tuesday morning?
Good morning, Tom. Well, Politico is even talking about the fact that even inside his own White House, people are very confused a little bit by President Biden's move towards the centrist. You have the left wing of the party really upset with the moves the Biden administration has made in terms of the bipartisan infrastructure deal and leaning towards those the right and those senators to get that deal done on Saturday, rescinding that he would not make a veto effort. So the left has some power here. You even saw protests from progressive groups outside the White House, and the struggle is going to be to make sure that they get enough votes for the House, but also in the Senate, it's to make sure, and you know, we heard from Mitch McConnell yesterday, Senator Mitch McConnell, to make sure that the Republicans also support this deal. And what Mitch McConnell really is putting the line in the sand is saying, okay, we heard from the president, but that rescinding on that veto will be a hallowed gesture if Speaker Nancy Pelosi and Senator Chuck Schumer also do not get on board with this deal.
Is there any reporting that the left is swayed by earmarks, by pork, by a 6-lane highway from Burlington on down to Rutland? I mean, to take Route 7 in Vermont and turn it into an infrastructure project? Does that work anymore?
You know, Tom, I think it will work when it comes to the human infrastructure part of the bill. That is what the progressive lefts want to see. They want to see expansion of funding for things like childcare, for Medicare. They want to see the taxes on the richest in this country go up. Those are the kind of earmarks that would work for the progressive left. I don't think you're going to see it as much when it comes to the hard infrastructure like pipes and bridges.
So in the meantime, President Biden is touring rural Wisconsin. He's talking to different farmers, agricultural producers. He's talking to Trumpers, frankly. Trump country, very much. What is his goal here? And what does it say about who the balance of power really lies with right now?
I think it's a two-part goal, Lisa. One is, of course, he wants to drum up support for this infrastructure plan, and a lot of this infrastructure plan is geared towards rural America. Part of it is, of course, expanding broadband to rural communities, but also expanding transportation in order to get crops quickly and more easily and sufficiently out into the rest of the country. But as you mentioned, this is Trump land, and Wisconsin potentially for 2022 could be a place that the Democrats are eyeing. Senator Ron Johnson has yet to decide. Last month, he said he was yet to decide if he was going to run again. He's a Republican. Potentially, if he decides to retire or do something else with his political career, this could be a seat the Democrats want. Now, for these rural farmers, prices have been good. I mean, he's going to Dairyland. Milk prices are up. $3.68 a gallon.
Okay, traders, you need to place stop on profit for euro. All of you guys who copied our trade, who decided to follow us on this trade, let's place stop on profit. We will place at 109.07. Okay? Stop on profit placed. Whatever happened, you will not lose any money. Okay, this is how it works with our strategy. If you want to get the strategy, please go to company.co.uk and you can get the strategy over there. Otherwise, you can stay with us and see how we make a lot of money. how we trade, basically, how we day trade. And if you're interested in our style, if you would like to get more, not only information, but if you want to be in control your earnings, you can get the strategy. You can practice for a couple of weeks, and then you can trade also successfully any securities you like. Okay, I'll speak to you later, guys.
And calling progressive leaders to make sure they understand that the president is still on board with this two-track system, working in tandem, the hard infrastructure bipartisan deal, but also through reconciliation, a broader package.
Let's do the important stuff, Anne-Marie. Who's your team? A little bit later.
For today, well, I'm going to root for England, and not just because I spent nearly 8 years in London, but for another reason, because of the team I want to win the whole UEFA.
Who's the team?
Italy, of course.
There we go.
I root
That's
with
all
you.
I wanted to hear.
Yeah, me and Jonathan support the same team in this.
There we go. That's all I wanted to hear. Anne-Marie Jordan, thank you. Down in D.C., Bloomberg, Washington correspondent. For those of you who wish to follow the president a little bit later, he'll leave the White House at about 10 Eastern. Then he'll address that audience, Tom, in Wisconsin. Those remarks coming at 2 Eastern time, a little bit later this afternoon.
Wisconsin is an important state. It's where there's a lot of 50-40. There's a lot of mixture there. There's a lot of communities and counties. I mean, we think of Madison as the People's Republic of Madison and everything else pretty conservative. But I'm sorry, it's as we saw in the election, John, it's the kind of state he's got a quote-unquote campaign in 24/7.
Two bills in play here, Lisa. Which bill gets pushed the hardest?
Yeah, and who's he lobbying? Is he lobbying his own constituents? Is he lobbying the populace? Is he still saying he wants to garner popular support at a time when there's so much dispersion among members of Congress? Go ahead, Tom.
Are two bills really in place?
Not
Very
in
much
place.
so. Very much so in terms of they're trying to pass them in tandem.
Right.
Lisa, in that sense, yes. Are they ready to go right now? The answer to that is clearly no.
Yeah, I mean, honestly, we haven't even seen the details or any really specifics of the larger reconciliation bill, which raises a question about the timeline. How can they get this to his desk with enough time?
The president speaking a little bit later this afternoon. I understand we'll take those comments right here on Bloomberg TV and radio. Equity futures 42.78 on the S&P. We're down not even a tenth of 1%.
Entry point.
I need one of those dashboards, Tom, and I'll just press a button as I'm speaking. And then you can just save your voice for the rest of the program.
That's true.
Yields 147.82. Anything to say? Nope.
No, you know,
Okay.
to 4 digits, I like it, John.
119 on euro dollar.
You nailed it.
Thank you, TK.
Euro's weaker.
From New York, this is Bloomberg.
Dodgers beat the Giants.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City, Tuesday morning. Good morning. Here's the price action this Tuesday. 42.79 on the S&P, basically unchanged after climbing to a fresh record high in yesterday's session. Year to date so far, up a little more than 14%. The best first half since how long, Tom?
9 years.
9 years. 9 years. Unreal. Nasdaq futures right now, 14,497. We're negative about 0.1%. A nice boost off the back of Facebook news yesterday. We'll talk more on that later in the hour. That's the story for the equity market. Let's talk about a sector, the financials. The equity market up 14% year to date. The banks up 28% year to date on the S&P 500. And we got that avalanche of news from each and every individual bank on Wall Street that passed those stress tests last week. And this is the news. Goldman Sachs boosting their quarterly payout by 60%. JP Morgan go to $1 from 90 cents. And then Morgan Stanley double the dividend. That stock is up by about 2.91% in the pre-market so far. So that's the bank story in the pre-market. Once again, more on that through the next couple of hours on TV and radio right here on Bloomberg. Here's the bond market. You need the bond market to come with that bank's call. How many times have people come on this program and said that? Well, here are 10s right now, 147.99. Tom Keene, how the bank bulls would like the JP Morgan version of the world to develop to materialize.
Yeah.
Jake Berry at JP Morgan still looking for 195 on 10s. Right now, sub 150.
Yeah, they want a 165 soonest and even break it out to 170. I think it's a really rich story, John. I mean, it's going to keep giving all through July. The bank stock story, the flows of money, the way they adapt their business, giving return to shareholders.
We couldn't get to 195, even with all the news that you'd expect to take yields to 195 in the first quarter. We topped out where? Just south of 180. What's going to get us there? They talked about the valuations. They've talked about the supply. They talked about the reaction function over at the Fed. That was true at the start of the year.
Yeah, I like the word hopium here. I think of Steve Major calling on a 1% 10-year yield. I mean, there's a whole group, John, going the other way.
Bookmarked, 195 at one end. JP Morgan, to your point, Tom, HSBC down at 1% right now, somewhere in between.
Mm-hmm. Interesting, a really rich market, folks, and of course all of this colliding with the data today. Housing data today, I looked very carefully at the housing data, and well, you know, it's not 2006, but we're getting there rather quickly, and then on to Jobs Day on Friday. Right now, this is really a joy. We don't do enough on the softs. We talked to Dennis Gartman about red wheat, but we really just don't do enough on the softs. She is expert on the soft commodities. Kona Hake is ED&F man, head of research with just a distinguished career in these trends. I want you to discuss, Kona, first, the linkage of your world to Brazil. Why is Brazil so important in getting on board a soft commodity trend?
Okay, traders.
Yes.
I'm going to place stop on profit. I'm going to move it even further to 119.04.
You name it, it's
okay, guys. So if you follow our trades and if you copy them exactly at the point where we decided to trade euro, please do so. Please place stop on profit, and you will make more profit. You will make more money on this trade. Do not concentrate on this trade. Do not trade like some people believe that you will get £1 million by just successfully trading one pair. Okay, I'll speak to you later, guys.
Has led to a boom in commodities. Now, whether we're in a super cycle or not, that's still debatable, but for sure we are seeing money flowing into commodities, and the soft commodity sector has definitely been a beneficiary to that. So we have seen speculative and investor buying across coffee, sugar, and it helps that the forward curves are in backwardation. So, you know, that's basically suggesting that the markets are slightly tight, and that's helped helped by the fact that Brazil has been very dry in the first half of the year, and that's really caused some concerns for yields, which just fuels concern.
Well, there's a question about the elasticity of some of these soft commodities, a question of how quickly you can plant, how quickly you can compensate for the increase in demand or the reduction in supply based on the droughts that we're seeing, not only in Brazil, but also across the United States. What asset classes, what commodities have the least elasticity, are the least capable of being produced quickly to meet the demand?
So I suppose for things like soybean and corn, at least you have other countries like the USA and Argentina that can compensate. So if Brazil has a disaster crop, you can look to the USA. But right now we have seen some issues. You know, it's very dry in parts of the US. The weather is turning a little bit better. So corn and soybeans, the rally in those commodities have come off a little bit. So we wait to see. The nice thing about the way these commodities work is that just when Brazil is exporting, that's when and then when they finish their export season, that's when the US starts exporting. So you have a nice little supply chain across the calendar year. When it comes to coffee and sugar, you're looking at more sort of the middle of the year when you start seeing harvest. So and there really isn't a lot of substitute areas to provide that kind of huge replacement. So we are more concentrated in the softs as such. But I mean, if I wanted to talk about the demand side elasticity, I mean, we're talking different things now. So for coffee, for example, the pandemic meant that lockdown cafes were closed across the world, if you like, and people had to drink coffee at home. And now there's a real hope that as lockdowns are lifted, people can go back to outdoor coffee consumption. That should provide a nice little boost there.
All right, well, maybe some people drink more coffee when they go out. Other people, like myself, drink plenty when I'm at home as well. There is a question just more broadly in the entire commodities complex. We've been talking about peak reflation, whether we have reached peak everything and whether that's being reflected in some of the commodity prices easing off where they were earlier in the year. Do you see that consistently around the commodities that are most sensitive to global growth?
So the agricultural side, I suppose, is less sensitive to economic growth per se. If anything, you'd say that emerging markets, more of the income is spent on staple food commodities. So it's more about as the countries move out of the COVID, their demand for basic raw materials is going to be very, very strong, and that is definitely happening. We are seeing food inflation, and if governments start taking wind of that and they start worrying about food rights, the likes we saw in 2008, they might want to start importing to start building strategic reserves to ensure that they don't have domestic food inflation. So I think, are we at the peak? I would say we're in the middle. I mean, certainly for some commodities, harvests are coming up. That should provide some supply pressure. But generally speaking, I think because interest rates are still so low and the rate hikes by the Fed promised are now still 2 years away, people need to put their money in, and I think commodities right now still feel like a good bet.
Conan, to switch to oil, and of course you followed that at Macquarie for years. I don't want you to single point oil out to $100, but do you see an identifiable trend in Brent crude that launches out to 80 and then 85?
I think the fact that oil has done so much better than even I thought, just a few months ago, suggests that the demand, we have really maybe underestimated the demand. So as more and more countries come out of lockdown, I think that demand can really spike higher. Maybe in the US, the demand growth from here is going to be slightly slower. We probably need aviation to take off for the next leg higher.
Right.
But at the same time, we do know that OPEC is now, bringing supply on. That's their plan. And I think if they go overboard or if there's more risk of cheating, then I think you could start seeing a little bit of a slowdown in the oil price growth.
Conan, John from Milan emails in and he says he's probably going to lose money on Germany, England today. What's your single best idea here for people that lose a pot this afternoon on that big soccer game?
I mean, if you look the way France is out, Portugal's out, I mean, if that's the same trend, then maybe Germany's going to go. I don't know, but England has a good chance.
Kona, I love that. That's the best answer we've had all day.
That's great.
It's unexpected. Kona Haig, thank you very much.
She's long champagne, I think, is what I heard there.
Man head of research. You'd be buying the bottom in France this morning, wouldn't you, Tom?
I guess so.
That was just terrible.
There it is. Somebody emailed in. I said, yes, Tang is a soft commodity, just so everybody understands.
Tang is a soft commodity.
John, seriously, we got to explain this, John. I mean,
Lisa, that's so true.
Carry on, John.
John, the legacy of this is so important. That's a romance thing, folks, but the legacy of this in London to the soft commodities, John, we just don't, in the modern day, we don't talk about it like we used to.
You're going back to the coffee houses of centuries ago, Tom.
Yeah, when I was there, you know,
the little
Grandpa
ring that you
King
draw
was
in
there,
the floor.
You know, Lombard and that. But no, I'm sorry, when I started out, soft commodities was a big deal.
Yeah,
you got on board a trend and, you know, cocoa and this, and it's like Mary Poppins, railways to India. And we don't do it like we used to.
Yeah, all right. Thanks, Tom. Crude this morning, Lisa. Brent crude. Close to 75 still. We broke that level in the past week or so. Brent 74.34. WTI 72.40.
Yeah, the interesting thing is you've seen the oil price maintain its gains much more than other commodities that have really come off. And I do wonder what this says, if this is more of the reflation trade and, frankly, people putting a pause on it, but not necessarily it rolling over, whereas the other commodities are much less clear, as Coda was talking about, in terms of what this means about global growth.
You got a baseball update, TK?
I do. I mean, the things that matter, Dodgers, Giants, both two great teams. Dodgers defeated the Giants. I mean, this is.
You haven't talked much about your Red Sox much recently.
I've been watching, actually. They're in the game, John, but not really. Every game is a struggle.
He doesn't talk about them.
Dodgers
That's why he
and
talks
Giants,
about the Padres.
Dodgers and Giants
The Padres
are like
count
every
now, too.
game is like stunning.
You're still looking for the Padres to win?
No, I'm not saying that. I would say maybe the Red Sox are more like England, like the way you've described England. Are they going to be fired up today? I mean, what's the emotion?
They're going to be fired up. The emotion is, you can trace the roots. You ever hear the story of the Christmas truce on Christmas Day?
Yeah,
where the
they
Germans
played soccer. Yeah.
played the English. So the story goes. I have no idea how accurate it is, but that's the story you're told again and again and again. That's what it goes back to.
I have a serious question.
Traditional rivalry between two mega nations.
Lisa, you never thought you'd get conversation like this when you bought into this.
I have a serious conversation based on what you guys are focused on today. Do you think that anyone on the trading floors will actually be trading?
London.
Or do you think that they're just going to be watching this game?
No, they're watching.
Fortunately, it kicks off at 12, which is 5 UK time, 6 over in Germany. So I imagine you leave maybe an hour, 2 hours before the close of the market to try and get a decent share at the pub to watch the game. I would have thought, or maybe you leave at lunchtime and have a long lunch that kind of merges into 4 or 5 p.m.
Liquid lunch.
If that works for you. Yeah. That's probably what London looks like a little bit later, Lisa. I imagine that's fairly accurate. Coming up, we'll talk about the pandemic with Dr. Emma Shadalja of Johns Hopkins. Your equity market, 42.78, pushing 4,300 on the S&P 500.
15.72.
Thanks, Tom.
Thank you.
Bond market, 147.99 on 10s. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. On Capitol Hill, the House passed its own version of legislation aimed at boosting research and development in response to China. The Senate passed similar legislation, although its version includes incentives for semiconductor makers. The two chambers will have to negotiate those differences. In Florida, a state legislator wants condo association rules and regulations reviewed following that deadly building collapse. State Senator Jason Pizzo says lawmakers should consider expanding inspection requirements. The condo collapse near Miami has raised questions about maintenance. At least 11 people have been confirmed dead. 150 are still missing. Morgan Stanley is leading big U.S. banks in raising payouts to investors. According to statements, dividend payouts by the nation's 6 largest lenders will rise on average by almost half, and that's with Citigroup abstaining. The bank's built up cash piles that easily met the Fed's capital requirements. Morgan Stanley doubled its dividend and announced $12 billion in buybacks. Bloomberg's learned that the Justice Department has stepped up scrutiny of Google's digital ad practices in recent months. That shows the Biden administration is pursuing an antitrust probe that started under former President Trump. The Justice Department sued Google last year, saying it was abusing its dominance in internet search. And in the UK, house prices grew at their fastest annual pace in more than 17 years this month. That's adding to a growing wealth gap that has policymakers worried. According to Nationwide Building Society, property prices rose 13.4% from a year ago. The average price is now $353,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Given how quickly it is spreading, it should be a concern because it can destabilize even countries that have done a pretty good job vaccinating. So for that reason, I think all these warnings are reasonable, and it's an extra push to get people vaccinated and to help people and others understand the importance of vaccination.
That was Joshua Schaufstein there, Johns Hopkins Bloomberg School of Public Health, the Vice Dean from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning, all-time highs at a close on Monday. Equity futures basically unchanged on the S&P. Let's call it 4280. In the FX market, euro weaker, euro dollar holding on to 119. We're down 0.2%. That's a weaker euro, a stronger dollar there. And in the bond market, settling down, unchanged, south of 150. Tom, 147.82.
Yeah, 147.82. Watch that very carefully. Got, again, the economic data here really critical. Today, housing, Case-Shiller, we'll look at that, but a lot of important economic data coming up at the end of this second quarter of 2021. Right now, Amish Adalja joins us. He's with Johns Hopkins Center for Health Security. He's been wonderful. He doesn't read the papers. Dr. Adalja reads things like Lancet. They read adult medical journals that inform on where we are. I noticed in Lancet, Dr. Adalja, a wonderful 12-paragraph summary of Scotland and the Delta Indian variant that we have. I can't translate it like you can, but what I see is a stunning growth of worry about this variant. What are you reading about Delta variant in the professional journals?
What we know for sure about the Delta variant is that it is the most contagious version of this virus that we've seen. It's more contagious than the original strain of the virus. It's more contagious than the Alpha variant, which had been the most contagious variant. So that means just by simple Darwinian laws, wherever the Delta variant is, it's going to infect and become the dominant strain. That's just a simple biological fact. And it's going to spread in those populations that don't have any protection, meaning people who are unvaccinated, people without natural immunity. That's where the main danger rises. And in places where there's a large proportion of unvaccinated individuals, you will see Delta being a disruptive force.
The summary of Sheik, McManaman, Taylor, and Robertson out of Scotland is the young and the affluent are more affected by the Delta virus. Is the variant, I should say. Is it more virulent? Is there a difference in illness strength, if you will, variant to variant?
It's very hard to tease that all apart. There have been reports from the United Kingdom as well as from China that there may be some more virulence with the Delta variant. But if you remember, they said that also about the Alpha variant, which never really were borne out. So I don't know that we can say that for sure. I think this is something that's important to study. People have also said that there's a different spectrum of symptoms, that there's less loss of taste and smell with the Delta variant. But this is something I think is going to take some time. I think all we can say for sure, it's more contagious, and that's why it's important for unvaccinated populations to be vaccinated.
Dr. Adalja, how big of a concern is this for those who are vaccinated?
If you're fully vaccinated, there's not any evidence that the Delta variant is going to be any problem for you. We've seen with the mRNA vaccines, especially the Pfizer and Moderna vaccines, that 2 doses is highly effective at preventing symptomatic disease. It is probably also the case with the Johnson & Johnson vaccine, especially when you're talking about what matters, serious disease, hospitalization, and death. A lot of the talk about the Delta variant, I think, comes back to what we're trying to do in this pandemic. It's not to get to COVID-0. It's not to prevent all mild illnesses. It's to prevent serious illness, hospitalization, and death. And our vaccines do that very well, even with troublesome variants like Delta or with the Beta variant. So that's the message. Get vaccinated.
Dr. Adalja, that's the message from you. We hear different messages from different health professionals, and we see different messaging when it comes to Israel's policy or when it comes to Los Angeles saying everybody now needs to wear a mask, including those who are vaccinated. Not necessarily a mandate, but highly recommended. How much daylight is there between your view and health officials who are putting into place policies that perhaps are not recognizing that we have crossed that line into treating COVID like any other virus?
There is definitely a disparity in what I'm saying and what other people are saying, because I think I'm someone that from the very beginning has thought of COVID-19 as an issue of trying to preserve hospital capacity, to trying to tame the virus, to make it unable to cause a public health emergency, not to drive it to zero, not to drive it to some elimination point, which I don't think is possible. So I think that what we're trying to do is make it like, as you said, another respiratory virus that we deal with year in and year out, that causes some hospitalizations, that causes some deaths, but is something that we're able to handle much better. And I think that's where we have to go, is moving away from that COVID-0 idea or focusing so much on cases, but really only looking at hospitalizations and deaths, because that's what we've tried to do from the beginning of this pandemic. But it's very hard for people to transition to that. And I think there are a lot of people who maybe implicitly have this COVID-0 idea, which is not something that's sustainable.
Well, Dr. Adalja, I mean, Dr. Sharfstein and others would come on this program and they say it goes beyond just getting the incidences down to zero. It means preventing the long haulers, the people with symptoms of COVID for a very long time that are expensive for the healthcare system. It goes to this idea that you can open up the borders more freely with less risk earlier. What do you say to people who push back and present those arguments?
I think those are all worthy goals. To get cases as low as possible is a worthy goal, but is that what should be tied to public health measures? That's where I have a difference, where I don't necessarily think that you need to have be using government force when your hospital capacity is not going to be compromised. I think right now we have the vaccine widely available. We're trying to get more and more people vaccinated. But I think at the point where people are undermining the vaccine, saying you have to wear a mask if you're fully vaccinated, that also doesn't make sense to me. And I think that there's a lot of differences in the way people perceive this risk. And to me, the systemic risk of COVID-19 had always been collapsing the healthcare system in terms of ICU capacity, personal protective equipment. Everything else is much more manageable to do, especially with a tool like the vaccine. So I think that we really just have to think about what this means globally for respiratory viruses. How do you get them to a manageable level? And I think that the mysteries of long COVID are something that's going to be unlocked. And I think those are important research questions to answer. But I don't necessarily think that that's what should guide every public health decision-making process, that's at the same level as a hospital in crisis, or not having enough masks, or not having enough ventilators. I think that's what we've been trying to do from the very beginning. And I think people forgot that's what flattening the curve was about. There was a big black line, which was hospital capacity. That was the goal that was articulated.
And then the goalpost got moved pretty quickly by a few people. Doctor, it's good to catch up. Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. And Lisa, the proposition for individuals has changed markedly over the last 12 months because of the vaccine. 12 months ago, it was about protecting you and protecting others. Do you really want to protect others if they've chosen not to protect themselves?
The one caveat there is that there are certain children who are below the
age traders,
and get vaccinated.
As you can see, we closed position at 119.04. How long we purchased short position at 11 o'clock right now? What time is it right now? 12 o'clock. 1 hour. We made 500 pounds. Well done, guys. Let's move on. Let's look for other pairs. For our customers who already use our strategy, please do so, and you got more chances compared to people that just following our trades to see what pairs, what more other indices or Forex pairs or other securities will give you chances to trade profitably by using our strategy. For other people, if you want to get the strategy, please go to companyi.co.uk. In our case, like I said, we made 500 pounds. In your case, depends how much you decided to trade when you sold short at 11 o'clock your contract or this position. Okay, I'll speak to you later, guys. Stay safe.
A bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Is running very, very hot above long-term averages, and that should push you into these cyclicals.
I think we've probably seen the best of it for U.S. growth.
We cannot maintain this 6%, 7% GDP growth rate in the United States.
This is going to be a tantrum-less taper. At what point does Powell lift his foot off the accelerator on financial dynamics in terms of pumping money into the system? And how will the market react?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
All-time highs coming into Tuesday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning with S&P 500 futures at 42.82. Tom, I think we've got to start with the news from United Airlines in the last hour or so. A huge purchase, a bet on the future. The airline agreeing to buy 200 Boeing 737 MAX jets, 70 Airbus A321 Neo planes. Tom, that's a big bet on a better future.
This is what we're going to see, John. End of the pandemic, corporations are going to get out front and bet on it, and the response of the market is to grind higher. John, just like yesterday, we're grinding higher. Dow futures just went positive. NASDAQ 100 is going to go positive before Lisa tells us what's going on in the real world. VIX, 15.64.
Lisa, please. Be our guest. Tell us what's going on in the real world.
Well, part of this is the airline story, this idea of can we get back to normal? And we're seeing increasingly that those plans are getting delayed. And I think you asked a really good question, John, earlier in the show, this idea, has it been delayed or has it been brought backwards in terms of the Delta variant, in terms of the coronavirus pandemic? And we're seeing certain restrictions being reimposed. I just wonder longer term how much of a speed bump this is in the recovery.
Well, look at the airlines over the past month, Tom. American down by almost 12%. Delta off by almost 10%, United off by around about 10%. There are some cracks in this cyclical story, and you've seen it in travel stocks over the past 30 days.
We're in the same room.
Cracks? My God.
It's the proximity, Tom.
Wait, we're not in the same room together?
We're not. There's about 30 yards between you and I, and only about 10
we should all get together. What can I say? We should all get together. What I would say, John, is there's an ebb and a flow to the market as well. James Gorman and the rest of them yesterday made a real change to the so-called ebb and flow. They put money where mouth is.
Doubled the dividend. Do you think that was the avalanche that a lot of people expected, though?
John,
Clearly it was an upside surprise for Morgan Stanley reflected in the stock price, but not for Goldman, not for JP.
Yeah, the dividend movement was great, John, but what's really important is what will be the sustained dividend? Not double digit. These guys aren't Apple, they're not Google, but can they give us high single digit 5-year dividend growth moving forward? That's the bet.
Well, the capital return plan is part of the bet. The other bet, Lisa, is in the bond market. The yields will come with us. Yields will come with us, and I'm saying us, I mean the equity market, bond market, bears, equity market, bulls, the bank bulls. They need the bond yields to participate in a way that they haven't over the last couple of months.
Yes, absolutely. And I think that Tom really nailed it when he's talking about, okay, this is great. What are you going to pay us next year? What are you going to pay us the year after that? And I will just put into perspective, yes, bank stocks, if you take a look at the dividends and the buybacks, probably are yielding 8-9% this year. That's the estimate from Bloomberg Intelligence. However, it was only 4.1% last year. A lot of this is just simply compensating for what was not paid out in 2020.
Let's talk about that in just a moment. Here's the broader market at the moment on the S&P 500. 42.81 on the S&P. S&P. Outside of that, in the bond market, yields 148.33, up almost a basis point. And the euro really struggling here, holding on to 119. We'll break it down again a little bit, Lisa, down 0.2%, 119.05.
Yeah, there's definitely a stability trade here. There are people questioning whether the pandemic is taking a bit of a resurgence, putting a pause on the recovery trade. Today, we will get a sense of how much of a pause there might be in the rapid price increases of U.S. homes. We're going to be getting the house price index from both S&P CoreLogic as well as FHFA. And there's a question here going forward about how much momentum there can possibly be, especially at a time when the Federal Reserve is thinking about perhaps reducing some of their mortgage purchases. Then at 10 a.m., we get U.S. consumer confidence. I am curious, under the hood, how confident are people that they can get jobs? How confident are people that they can get price increases from their wages? And this, to me, is probably one of the best leading indicators at a time of such messy news and such messy data points. And then at 2 p.m., President Biden will be in the rural areas of Wisconsin talking about infrastructure, talking about support me. And I am curious to see who he is speaking to, John, at a time of so much dissonance, not only among Republicans and Democrats, but within the Democratic Party.
Let's do another talking about. Is he talking about the bill he's agreed with Republicans, or talking about the bill we have yet to see from his own party?
I think that will be a really interesting thing to see, right? I mean, who's he selling what to? Is he selling a bigger infrastructure plan to them to try to get Republicans on board, or is he pitching the $579 billion plan to garner enough support to overwhelm the Democratic fringes?
We talked a lot about uniting the country, Tom. Less about uniting Congress over the last couple of months.
Well, Congress is where it is. I mean, to me, it's just going to happen. I mean, I thought Anne Marie Horton captured the color down there, John, the heat of Washington right now. It's obviously a fractured Democratic Party. Am I engaged in it? Yeah. Is there going to be a bill? Well, I guess there's going to be. But really, John, do we know what it's going to look like? I don't think so.
It's going to be big. The other bill is anyway. Yeah. It could be what, $6 trillion?
$6 trillion. Yeah, Bernie Sanders has got his, his pen in that one, and he's crafting that.
Okay, could have a 6 in front of a T. Unreal. Equity futures this morning, 42.80 on the S&P 500. Joining us now is Mona Mahajan, Allianz Global Investors Senior U.S. Investment Strategist. Mona, let's just start here. The cyclical trade, seen some cracks through the month. The banks struggled at one point. The airlines have been struggling over the past 30 days too. Do you want to stick with it?
Yeah, generally, obviously, we've had a phenomenal run in the value trade, and we talked about this since November. We've been up. Energy's been up nearly 90%, financials up 50%, industrials up over 30%. So, it's been a good run, and I think certainly people were anticipating, investors were anticipating some of the recovery that we are now seeing in the economy. But as we're standing here today with the 10-year again under 150, when you think about the upside downside on the yield profile, if you really think yields have much more downside to go, then perhaps you step back from the value trade. But if you think that yields now may start to either stabilize or grind higher, given both technical factors and fundamental factors, then I think there is one more leg in the value trade to come. Keep in mind, as we move through this year, as the Fed starts to taper eventually, as the reopening occurs in earnest, that will support the value trade. But as we head into 2022, we are looking at comps that might get a little bit harder for some of the value sectors, and comps that get once again easier for some of these growth tech names again. So we do think as the year progresses, the more and more interest, or there will be more and more interest in some of the tech trade. But for now, we stick with the value.
Mona, American investors like to buy America. They don't want to go un-American. You say go long the un-American European stocks. These are unfamiliar names. ASML, LVMH, we know that's not unfamiliar, unfortunately. SAP, Linde, and Total, the French oil company. Should we be buying European big caps?
We think Europe obviously has levered towards the value trade. A lot of their sectors and indices are long financials, long industrials, a lot of great European industrial companies, and long energy. So classic value sectors in Europe right now, combined with a European economy that's also catching up in terms of vaccine rollout, in terms of economic recovery. That being said, when you look at some of the index performance already year to date, a lot of European indices are in line, if not outperforming the S&P 500. So some of that catch-up trade has been had. But that being said, we do think that as this global recovery is unfolding, investors need to think more global in their portfolios as well. You know, earlier this year, there was a period of what we call U.S. exceptionalism. The U.S. really came out strong in the March timeframe with their vaccine rollout. Economic recovery started in earnest during that time period. But now we are starting to see this unfold globally. Of course, we're watching the variants, as you guys noted earlier as well. But through the summer months, we do expect some stability in not only the European economies, but some of those EM economies that really were lagging. You know, think areas like India, like Brazil, that are now starting to show signs of stability. Their markets are playing catch up as well. And if we resume a softening dollar trend, we do think that over time that supports some of the real laggards beyond just Europe, but parts of those EM as well.
Mona, there was a lot in there. Let's unpack one point. You said that you are watching the Delta variant and how that is spreading. How does that play into your thesis? How much and how closely are you watching that to determine when you perhaps should shift gears?
Yeah, you know, it does really seem to be a race between vaccines and variants. And I think here in the U.S., we've done a really good job. I mean, the vaccine rollout perhaps won't hit the 70% target by July 4th that President Biden had outlined, but we're getting pretty close. And so in many states, we are now at 70% or higher. We think that's a pretty good situation to be in to fight or offset some of the growth in the variants. Aside from the variants, the other thing that we're watching closely is the seasonality of this, this COVID, I guess, the COVID itself. And so, you know, when you think about it, as the September, October months roll around, that really could be when we see a surge in cases once more. And so we are, you know, looking at the summer months in line with last year's summer months where we're seeing a plateau in cases. But keep in mind, seasonality is a big factor here, as are the variants. These are tail risks in our view, not really a base case scenario.
Mona, always good to see you. Thank you. Mona Mahajan, Allianz Global Investors Senior U.S. Investment Strategist. Lisa, let's explore that a little bit further. Do you look for the data, the continued decoupling between cases, hospitalizations, and ultimately death? Do you look to other things like policy, changes in policy, just small recalibration of the effort there that might choke off growth or at least slow down the reopening process? Or do you wait for everyone else in the market to see what they think? Do you wait for price to start to adjust before this narrative really starts to change?
There is an economic effect when you do have restricted policy on the heels of more cases. So that does have a direct economic effect, and you're seeing that, as you mentioned, in the airline stocks. People saying perhaps it's a chance to buy them. I don't know. I mean, honestly, the bond market's not sending that message.
Biggest myth of the year so far? That Europe lagged. Stocks 50, Euro Stocks 50 is up by almost 16%, Tom. Almost up 16% year to date so far. Already outperforming the S&P 500.
You know, I'm glad you bring that up, John. I think it's really time to look back and say, what did we get wrong all in all? And to me, the answer is bond stasis. We thought we'd get movement in yield. Yeah, we got some movement, but a 140 is still a really low yield as well. It's going to be really interesting to recalibrate here in one day.
The sell-off stalled at the end of the first quarter in the bond market. What does the second half bring? Another couple of days to go. 42.79 on the S&P. You feel comfortable in cash still?
I'm comfortable.
Okay.
I'm looking for an entry point.
148.33 on a 10-year this morning. Good morning on TV and radio. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. It's a record purchase for United Airlines. The carriers agreed to buy 200 Boeing 737 MAX jets and 70 Airbus A321neo jets. The deal's valued at about $15 billion. Those new jets and other United single-aisle planes will get a revamped cabin with seat-back screens and larger overhead bins. It's a sign that United plans to step up competition with its two big U.S. rivals, Delta and American. President Biden is defending his decision to order airstrikes against Iran-backed militias in Iraq and Syria. The president pushed back against members of Congress who questioned whether he should have consulted them first. There's been no public reaction from Iran's president-elect Ibrahim Raisi. House Speaker Nancy Pelosi's moved to create a select committee to investigate the attack on the Capitol. The panel would have subpoena power and no deadline. Senate Republicans blocked creation of an independent commission. Legislation creating the committee would give Republicans 5 of the 13 seats. And it's a milestone for Facebook. Shares of the social network rose after an antitrust victory helped push its market value above $1 trillion. Facebook's now the fastest company to reach that level. A judge granted its request to dismiss 2 complaints filed last year by the Federal Trade Commission and state attorneys general. And JP Morgan reportedly is boosting pay for junior bankers. According to the UK's Financial News, the bank is now offering first-year analysts starting salaries of $100,000. Younger bankers on Wall Street have been complaining of longer hours due to the boom we've seen in M&A. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Is inflation just at the moment, or in other words, transitory, or will it be enduring? And I at least think there's a material risk could be enduring, and I think that policymakers should act accordingly. On the other hand, there's also a material possibility, as so many will argue, that it's transitory, in which case we'd be okay. As an investor and as a policymaker, I would have a cautious bias.
That was Robert Rubin there, the former U.S. Treasury Secretary, speaking at the Aspen Ideas Festival. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz, Jonathan Ferro. And Tom, I have to say, Mr. Rubin sounded a little bit like Mohammed Al-Arian, more balanced view of what's going to come down the road.
That was textbook Robert Rubin, and I don't mean the controversy of his tenure at Treasury, John. I mean the language that he reinvented at Goldman Sachs. He was a guy who changed how we spoke on Wall Street. He said there, on the other hand, okay, we know that from economics, the word I associate with him is likelihood. He's the one that took the probabilistic tendencies of trading and said the likelihood of this will be this and that and the other thing. There's a Rubin on the likelihood of likelihood. John, that's the likelihood right now of what this market's going to do.
Two perspectives I think are important here, Tom. The perspective of the investor and the perspective of the policymaker. It's not the same.
No, they're absolutely not the same. That's 100% right. And of course, I think Rubin would agree with us. I'd love to have him on. And Secretary Rubin, if you're listening, we'd love to have you on to talk about how it's fiscally absolutely original. Let's go there right now. We do this red and green on the screen. Dow futures are green, but SPX slightly negative 1.50. Jack Fitzpatrick with us on Bloomberg Government. Jack, let's pause and look at the size of the Rubin debt and deficit in Washington. Does anybody down there in the heat understand the new math of the debt and the deficit?
There definitely is a debate in Washington over what could be considered new math. You know, when I talk to Democrats, they shy away from using a phrase like MMT, but you hear a little bit MMT-esque language from Democrats who are sort of in the mainstream. If you ask John Yarmuth, the House Budget Chairman, who's crafting the framework for a lot of these legislative proposals about debt as a percentage of GDP, he doesn't necessarily think that's the metric to look at. They're concerned about the possibility of inflation, but whether we're at debt as 100% of GDP or going upward to 117% in a decade under Biden's plan, that's not the scary thing for Democrats that it used to be.
To continue the Rubin likelihood, what is the likelihood of more debt in Washington on our balance sheet? I mean, it's just a given, right?
Yes, the likelihood of more debt being added in Washington is about 100%. The question is how much. You know, when you talk about these big proposals that the Democrats want to use to follow up on this infrastructure bill, will it be $6 trillion or maybe slightly less? Maybe the bigger question is not just the spending total, but how much will be paid for. We've heard talk from Democrats that this could maybe only actually be halfway paid for rather than fully paid for. So that's one of the outstanding questions is, are we talking about a matter of hundreds of billions or maybe even trillions in the near future being added to the debt somewhat quickly?
Jack, how important are the labor reports, including the one that we're getting on Friday, to garnering support for more spending?
At this point, I'm not sure that has a direct effect on congressional support for more spending. Really, we've gotten to the point where the president and lawmakers know what they want to spend money on. And a lot of these proposals are not meant as a stimulus necessarily, not meant to inject a bunch of money into the economy. Ideally, the president wants to offset the cost, but it's a bit more of a focus on redistribution, on addressing policy areas that they haven't addressed on climate change, on taxes. But it's not necessarily, if there's a negative job report, we really need to act to spend more. It's more a matter of addressing policies that Democrats haven't had a chance to address in a long time.
Jack, this is important, especially at a time when central bankers around the world say that the fiscal impulse still has work to do to help the recovery gain the speed that it needs to gain in order to get us out of here. How many politicians on Wall Street are talking about that? Or is that basically off the table? This is just really ultimately, at this point, about your ethos, about the role of government going forward.
That is sort of one of the ideas underpinning the Democratic approach and the Biden administration approach. Looking back to the recovery in 2009 or so, Democrats have talked a ton about how there wasn't enough of a fiscal push. They reined things in too early. There's a huge reluctance to try to rein things in further. They're very reluctant to go to some sort of super committee, budget control thing where they would reduce spending in the long run significantly. But again, at this point, they got their major stimulus early in the Biden administration with the 1.9 trillion stimulus. That is sort of an issue that underpins these talks, but it's not the main focus of these talks. It's more the policy issues.
Jack, never say never, but we had one House yesterday talk about 24 months of 6% real GDP growth. Why are we talking stimulus given a truly boom and extended boom economy?
Well, that's what I'm getting at is I don't think we really are talking stimulus. The issue with all the spending and the fact that it may not be fully paid for, may only be halfway paid for, is less a matter of lawmakers focusing on stimulus and more just the difficulty of agreeing to pay fors. They may cut some corners and spend what they want to spend and then only halfway pay for it, not because they're here talking about the need to inject a lot of money into the economy, but because they have a lot of priorities they want to address, and it's very politically difficult to agree to raise taxes. But compared to the early stimulus talks, these negotiations are not really in the context of a quote-unquote stimulus. They're more just a matter of addressing the many things Democrats have wanted to address. And they'd like to pay for it, but it's a difficult thing in Washington to actually agree to pay for all of your priorities.
Jack Fitzpatrick, down in D.C., our Bloomberg government reporter. Thank you, sir. Your 10-year yield, 148 on a U.S. 10-year. Yields are higher by about a basis point off the back of this conversation, Tom, and we're sub 150. That is not where people thought we'd be at the start of the year.
The price
a lot of people thought we'd be making this move to 2%.
Yeah, you're right, but price is crashing this morning. John, look at DXY, the blended dollar big currency index, 92 handle. That gets my attention. It's not, again, it's not a breakout, but it's a little bit of a oomph to the dollar.
Euro's been a bit weaker over the past week, Lisa.
Yeah, the key question that I have is that Congress members have moved past the pandemic. They've moved past the recovery, and yet we still have labor market weakness and frictions. And I do wonder how the fiscal spending will dovetail into that, John, in order to get some sort of critical speed. It's a question to me.
Payrolls on Friday. The biggest call right now on the street. 1 million plus coming from Pantheon. Ian Shepherdson, good friend of this program. 700K, your estimate, Tom.
How did Britain lose to Iceland in 2016?
You mean England?
Yeah.
Yeah.
How?
Iceland were a nice team. They had a great fan base. You don't want to put, how does Britain lose to Iceland? Coming up at the commercial break, Tom and I talking football.
I'm learning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV and radio this Tuesday morning. Good morning. Here's the price action. 42.78 on the S&P 500, down by 0.05%. The Nasdaq pulls back from all-time highs, negative just 17 points, a break of 15,000. Not there yet. 14.95. We're down by 0.1% on the Nasdaq 100. Coming into Tuesday, though, at a record on the S&P, at a record on the Nasdaq as well. Switch up the board about confidence in the future. That's what I want to talk about. Confidence in the future. United Airlines ordering 270 jets. Scott Kirby, the CEO, talking about a 100% return of business travel. Year to date, the S&P 500 airlines are up close to 16%. Over the last 30 days, it has not been pretty. We're down by almost 12% on American, on Delta. We're down by 9.5% on United, down a little more than 10%. The Delta variant story I find to be absolutely fascinating. Broad-based macro story, apparently we're not there yet. Concentrated travel story, apparently we are. And I just wonder, for how much longer will that be a concentrated story? Switch up the board and get to the bond market. 2s, 10s, 30s, just to wrap things up. 10-year yield, 148.50. On 10s, yields are higher by about a basis point. On 30s, 2.1%. On 30s, we grind higher by about a basis point. Lisa asked the question a little bit earlier on. When do you start to worry about the Delta variant, Tom? Do you look to the data? So far, caseloads, yes, cases have picked up materially in places like the UK, in Israel. But the relationship between cases and deaths and hospitalizations is not as tight as it once was. That's good news. Do you look to something else, the policymaker that might start to tighten things up? That's what this story has been about in the airlines. Tom, do you look to something else? Do you just wait for price to correct and then the narrative starts to build on itself?
What I'm watching is a total correlation of this to percent vaccinated. It's just real simple. Some nations don't have it, including beleaguered poor Africa, and there's other nations that are just way, way behind, and they got to get up to, I don't know what it is, John, 45.2, 45.3% U.S.
But Lisa, the UK has it, Israel has it, and we're still having this conversation.
I think that the question that you asked, which is at what point does this become a macro story, is the key one. Why is this so isolated if it is having an effect on activity around the world?
We're not there yet. 10s right now, 148.50 on a 10-year yield. Let's get you some stocks on the move. Here's Romain.
Yeah, good morning, John. Let's stick with the travel theme. Of course, you had the airlines up there on the board. Boeing also getting a slight bid here in the pre-market, up about 0.6% here. A lot of this, of course, has to do, of course, with those 270 jet orders by United. 200 of those are for Boeing 737 MAX. Remember, Boeing shares had sold off the previous couple of days because of concerns about a software issue with a different plane, the 777, that's in development now. The bid today, not enough to sort of overcome all of those losses here. But again, you talk about the long-term story, and those orders do appear to be coming in, at least for that 737 MAX. The other big story late yesterday, of course, was Facebook. Of course, two interesting complaints, one by the FTC and another by a coalition of states. Those antitrust complaints thrown out. The complaints were thrown out, but not the cases themselves, and that's an important legal distinction because it means that the regulatory cloud still is above Facebook for right now, and of course, the states and the FTC can refile those complaints by the end of July if they so choose. The strategist we talked to yesterday said they will choose to do that. What got priced into the market yesterday was a 4% pop on Facebook. The idea that the government's effort to crack down on Facebook and other big tech companies is going to be a much harder slog. Those shares up fractionally here in the pre-market. Also in the transportation space, an interesting note out by the folks over at Citigroup, upgrading some of the railroads, including CSX, to buy CSX, up almost 3%. on the day. Now, flip up the board. I know you guys have been talking a lot here about the banks, and you're going to talk about that in just a moment. Of course, we did get a lot of those dividend and buyback announcements here. Of course, you had J.P. Morgan going up about 10% on its dividend, Bank of America going up 17%, Citigroup up about 60%. The big surprise, though, I think was really Morgan Stanley and Wells Fargo. Morgan Stanley, of course, doubling its dividend for the quarter and, of course, announcing that buyback plan of about, I believe, $12 billion. Also, late yesterday after the bell, we actually got earnings out of Jefferies, and that was an interesting move there, too. They pretty much beat on all the main metrics. That investment banking backlog right now, guys, at a record level.
Ryan Bostic, thank you so much. Really interesting to see where the banks are when we do the close this afternoon with Mr. Bostic as well. John Farrell, moments ago, Ira Jersey, who I love on overnight repos and all the fancy short term, just took his mid-course correction 2022 out to 2.32%. It's a different banking industry if we get a Jersey yield in 2022.
Quite clearly, if we get a steeper curve and a higher 10-year yield, the bank bulls get what they want to see. We haven't seen that since the end of the first quarter.
This is what surveillance is about. We talk to one analyst and go right to another analyst where we can link them together. Ira Jersey on yield, and now David George on the outcome for the equity market, and of course the banks, his expertise at Robert W. Baird. David George, if we get an Ira Jersey 10-year yield, 2.2%, 2.3%, what does that do to bank equities?
If we get that, Tom, good morning. I think that it's fair to expect if you're going to pin me down to a number, 10 to 20% upside for bank stocks, if that's the outcome. That obviously, in addition to the rate environment itself, that obviously reflects a much stronger macro backdrop as well. So that undoubtedly would be positive.
How do you calibrate the oomph of this one-off in share buyback and particularly dividend increase with a sustained dividend growth? What kind of model do you have for these big banks as they try to figure out the sustained dividend that they will give shareholders?
Well, over time, we're of the view that most of the big banks, and I say this as a positive, are going to be very utility-like with respect to how they distribute capital. I would expect over the longer term, the 3, 5, 7-year time horizon, you're going to see close to 100% capital return to shareholders, both in the form of buyback and dividend. And obviously, the buyback discussion can be variable depending upon movements in the economy, stock price movements, et cetera. But I think that the punchline is that there's going to be very significant capital return out of the financial services industry over the next several years.
David, Mike Mayo of Wells Fargo came on the program last week and said that right now, with all-in payouts, the yield on these financial stocks will probably equate to something like 8 or potentially even 9% for 2021. How much can people buy these shares for simply the payouts versus the dynamism from a steeper yield curve, from greater consumer lending activity, things that perhaps we're not really seeing as much?
I think part of the investment case is clearly capital return, but I think buying banks on that alone is probably somewhat of a frail thesis. I think in order to be very bullish from these prices, and again, to kind of give you some perspective, banks are up over 100% over the last 12 months. They're up over 25% on a year-to-date basis. So clearly, there's significant expectations priced into them today. So I think that the challenge is from here, capital return from my perspective is very positive, but it's not enough to make a very bullish call for financials from these levels. I think for the group to do well, you need higher rates, you need more loan growth, you need continued strength in the capital markets, and again, as you said, that kind of remains to be seen at this point.
Okay, let's put the rates picture aside, since that's less determined, frankly, is anyone's guess. There is a question about loan growth, and Allison Williams of Bloomberg Intelligence and I were talking yesterday, and she said really the untold story over the past month was from these bank executives saying that actually consumer loan growth is sluggish, that J.P. Morgan, Citigroup is actually seeing disappointments in that area, particularly with respect to credit cards. How much have you noticed that? How concerning is that to you?
It's not concerning, but it's absolutely a factor. Allison is right on as usual, and basically, in simplest terms, the government stimulus has crowded out loan growth. That's basically, from my perspective, really what's happening here. The amount of stimulus has been so significant that it has really eliminated the need for many entities and consumers, frankly, to really binge on borrowing. Now, I think that will change over the next couple of years, but over the short term, it shouldn't be a significant surprise because it's very much in bank deposits. If you look at deposit growth for the banks, it's been well in excess of loan growth for the last several months. So in order for us to see loan growth improve, we would probably need to see deposits start to come down, and that frankly hasn't happened yet.
Will it happen with these announcements of capital deployment? If they're going to buy back shares, they're going to use cash to do that. They, by definition, become smaller entities. You leverage out what they've got left there onto their balance sheet. And with that, do they preclude growth? Do they limit their growth?
No, they don't. If loan growth does not manifest itself in a meaningful way, ironically, most of these companies will generate capital faster because they're not growing their balance sheets because of that lack of loan demand. So I don't think that any pickup in share buyback activity, Tom, has any implications for loan growth.
David, love catching up. It's good to hear from you. David George there, Robert W. Baird, Senior Research Analyst. And Lisa is right, it has crowded out loan growth, but it's also really, really supported debt issuance in a massive way on the corporate side, and sovereigns too, for that matter.
And not just debt issuance, but also where the proceeds are going, which is mergers and acquisitions. And you're seeing that banking sector absolutely flying. We saw that with Jefferies' returns yesterday with their results. Question is, how long can that last, right? I mean, how long can that sustain the bank earnings if there is not loan growth and if consumers have somehow, gotten more financial discipline for a longer term?
It's going to take until the back end of this year, Tom, to really sort any of this out, to address any of this on both the bank side in terms of the loan growth and the fiscal effort crowding that out. Then on the labor market, that mismatch between supply, demand, again and again and again.
I haven't seen a day, John, in ages where you sound so much like Lisa. I mean, you're like channeling Lisa today.
Well, when we're talking about the labor market, I think you've just got to wait. You've got more than 9 million job openings in the United States of America at the moment. I'm not going to make the argument that it's unemployment insurance. Other people are. Republican governors have done that. We'll find out in September when it all expires, and we get the go back to school effort too.
I'm going to look at GDP growth, and I'm also going to look, John, at what the earnings season brings. And as you know, there's a heated debate over what earnings season will bring. Frankly, I'm enthused when I see something like the United announcement this morning.
John, Tom keeps thinking I'm so gloomy. I'm not the one in triple leveraged all cash. Just saying.
That is so true.
Well, I'm just,
saying.
I'm planning.
That is the perfect comeback.
I rebalance every Friday.
Do you?
Into more cash.
Into more cash. It's good to know. You get paid weekly.
Yeah.
Coming up, 8:30. Matt Lizzetti, Deutsche Bank chief US economist. 4278 on the S&P from New York City.
Watch another episode of Love Island.
Have you seen that?
Jake and Liberty. I think Jake and Liberty just, they're just killing it.
You're following it more than I am.
I am.
This is Bloomberg.
Germany or England or Jake and Liberty. You make the call.
With the First Word News, I'm Ritika Gupta. On Capitol Hill, the House passed its own version of legislation aimed at boosting research and development in response to China. The Senate passed similar legislation, although its version includes incentives for semiconductor makers. The two chambers will have to negotiate the differences. The American father and son who helped auto executive Carlos Ghosn's escape trial in Japan have apologized. Michael and Peter Taylor told a Japanese court that they made a mistake, that they deeply regret. The two could get a 3-year prison term. They were extradited from the U.S. earlier this year. Morgan Stanley is leading the big U.S. banks in raising payouts to investors. According to statements, dividend payouts by the nation's 6 largest lenders will rise on average by almost half, and that's with Citigroup abstaining. The banks built up cash piles that easily met the Fed's capital requirements. Morgan Stanley doubled its dividend and announced $12 billion in buybacks. And Bloomberg's learned that the Justice Department has stepped up scrutiny of Google's digital ad practices in recent months. That shows the Biden administration is pursuing an antitrust probe that started under former President Trump. The Justice Department sued Google last year, saying it was abusing its dominance in internet search. And in the UK, house prices grew at their fastest annual pace in more than 17 years this month. That's adding to a growing wealth gap that has policymakers worried. According to Nationwide Building Society, property prices rose 13.4% from a year ago. The average price is now $353,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We really feel that it's important to get the flywheel going. We're choosing to constrain capacity so that we can learn, because we have to learn. And our objective is to bring our ships back fairly quickly. I would expect the majority of our fleet to be back operating before the end of the year.
He's optimistic. That was Richard Fain, Royal Caribbean Chairman and CEO from New York City this morning. Good morning. Alongside Tom Keene, Lisa Browitz, I'm Jonathan Ferro. The price action is Tuesday. Coming into Tuesday at all-time highs on the S&P. We pull back now by almost 0.1%, 42.76 on the S&P 500, 149 on 10s this morning. Yields are higher by about a basis point. The euro just holding on to 119, 119.00, negative 0.2%.
There you go, 118.99.
There's your break, Tom. Yeah. 118.99 on euro dollar.
It's really interesting to see, and we'll follow that today. Of course, economic data here coming up in 45 minutes or so, and then on to the jobs report on Friday. Now let's touch on equities quickly. David Wilson joins us on the broader S&P 1700. David?
Yeah, absolutely, Tom. What we're talking about here is something called the S&P Completion Index. S&P has a really broad market gauge called the Total Market Index, so they take every stock out of that that's also in the S&P 500, and that's your completion index, roughly 3,400 shares in this gauge. And so what's happened is that we've really seen a resurgence in the completion index relative to the S&P 500 since mid-May. And in fact, on Thursday and Friday, we saw this index set records. What the chart tracks is the ratio between the index and the S&P 500, which has been moving up lately. So it's a sign that, you've had some broader strength, at a time when other indicators are pointing in a different direction. Specifically, you look at the S&P 500, the percentage of stocks above their 50-day moving average, and it's coming down, so that's caused some concern. This indicator tells a different story.
David Wilson, thanks so much. Too short a visit this morning. We'll do much more here as we go strong into the end of the first half of 2021. Right now, and this is fun for me because it is an applied world, and certainly all of the Bloomberg world and so much of our good listeners and viewers in global Wall Street, it's applied. And then there's a pure research of it. It's fallen by the wayside in the last decades. And what we know at Bloomberg, and certainly what we know from our leadership, pure research matters. Andrew Brown spearheads our New Economy Forum, and he's put together a team of scientists and pure research types, an eclectic group called Catalyst that simply look back to the golden age of 1957, the year of IGY. No, not Donald Fagen and Steely Dan, but back when pure science mattered. That's really what you're doing here, Andy. Thank you for joining us quickly today. These catalysts are about doing research and figuring new things out.
These catalysts are about problem solving. So the Bloomberg New Economy was set up by Michael Bloomberg in 2018 to bring together leaders of East and West, the industrialized North, the emerging South, to address the biggest problems facing humanity. This Catalyst program is intended to turbocharge that effort. So, we were kind of inspired in some ways by the pandemic, which gave rise to this wave of innovation and creativity. And the problem solvers that we've got together include people like Nubar Afeyan, the founder of Moderna, but also small entrepreneurs, a lot of women in Africa, Middle East, Latin America, who have used the pandemic as a way to address some of these big problems, not just disease, but food security, access to finance, access to energy, and so on.
We are in awe of Moderna and Pfizer and all these other people that created the miracle with mRNA and all that. And again, that goes back to pure research over to the more entrepreneurial people you have that are clearly applied right now. Do they have support of governments, or do these catalysts feel alone?
I kind of, the analogy I think about is the analogy with World War II, where you had this incredible global crisis that gave rise to a huge number of innovations directed by government. So you had, for instance, mass production of penicillin. You had microwave communication. You had radar. You had, of course, the Manhattan Project and the atomic bomb. But you also had, coming out of this pandemic, a host of innovations. Now, it's not a coincidence that you had a technology like messenger RNA, which had been sitting around basically languishing for decades, which suddenly, when the pandemic struck, found its application. And within a matter of weeks, you had a vaccine, which is helping to bring the pandemic to an end in the United States and large parts of Europe.
Andy, you mentioned World War II. You mentioned the 1950s, which was definitely spurred by the Cold War between the U.S. and Russia. And today, we have a new galvanizing feature, although perhaps not so great when it comes to collaboration. A question of the U.S. U.S. and China, or the Western world versus China versus the East. How easy is it to get people to work together? How much of a common cause is there versus a competitive spirit underpinning a lot of these advancements?
Space is actually a collaborative frontier. Most missions into space are now multinational. Again, it's not a coincidence that in this pandemic, even as the pandemic has been raging around the world, we've had no fewer than 3 missions to Mars. 2 landed rovers on Mars, 1 U.S., 1 Chinese, and another from the United Arab Emirates actually orbited the Red Planet. And that one from the UAE is particularly interesting for us. In fact, one of our catalysts is the UAE Minister for Advanced Technology, Her Excellency Sarah Al-Amiri, and UAE is looking to space to look at life beyond oil. So putting together technologies, developing the human capital, human talent that is needed to drive the UAE economy, which of course is heavily oil dependent in a post-fossil fuel world. So the idea of space, I mean, there are a lot of people looking at space, Elon Musk and Jeff Bezos and so on, potentially as an escape from all the problems on Earth. You're going to set up colonies on Mars and look back at a burning planet. Our catalysts are actually looking at space as an answer to problems here and now on Mother Earth.
Andrew Brown of the New Economy Forum. Andrew, looking forward to all the work that you and the team are going to produce through the next several months and through the rest of this year as well. Andy, thank you. And Tom, it goes back to a story we've discussed many a time over the last year or so, over the last 12 months. If last year was a catalyst for all this change, will we be surprised more by how much change is or by how much things remain the same? And that's going to be a story sector to sector through the whole of this economy and beyond.
Yeah, it's going to be interesting to see. I mean, all in all, the catalysts are there, but you're pounded against the government, the fiscal deficit and such, and that creates that worry that's out there. Again, I would look to corporations, John. They're adapting to what we see right now, and that's this massive bull market that so few are on board.
United Airlines ordering 270 jets. Lisa, that's a bet that things remain how they used to be before the pandemic.
Although trying to rejigger things and get a competitive advantage in a reset world, and perhaps that is what we're seeing more than anything.
100% return of business travel is the call coming from Scott Kirby.
Stunning announcement
this morning, the CEO of United Airlines.
Yeah. As of when?
Exactly. Isn't that the cheat guide for any strategist? You make a call, but you don't offer a time.
Yes.
Isn't that always the same? Coming up, Mike Bell of JP Morgan Asset Management, global market strategist out of London, from New York City this morning. Good morning. 4276 on the S&P 500. Heard on Bloomberg Radio, seen on Bloomberg TV from New York City. This is Bloomberg Surveillance.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Is running very, very hot above long-term averages, and that should push you into these cyclicals.
I think we've probably seen the best of it for U.S. growth.
We cannot maintain this 6%, 7% GDP growth rate in the United States.
This is going to be a tantrum-less taper. At what point does Powell lift his foot off the accelerator on financial dynamics in terms of pumping money into the system? And how will the market react?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television as well. An interesting Tuesday into a raft of economic data through the week. We've got the bank story, the Facebook story. John Ferro, we've got the Euro story, little tea leaves on our Bloomberg screen. And I'm sorry, weaker Euro says something.
A break of 119 briefly, a dollar index with a 92 hand. And I think it's been forgotten that the dollar topped out earlier on this year, at the end of March, when 10-year yields topped out. Dollar index had a 93 handle. Your 10-year yield was pushing 180. Now, Tom, since then, a lot of people will make the argument that that was about U.S. exceptionalism, that the rest of this year will be about Europe reopening, then EM. That dismisses the fact that Europe has already outperformed on the equity side already so far this year through the first half. The Euro Stoxx 50 has outperformed the S&P 500. So I think it's really, really difficult to make this international call. Didn't work in Q1 in terms of the U.S. exceptional story playing out with a dollar and 10-year yields. I just wonder if it plays out in the back half.
Well, it's a reset in the back half, and Lisa Abramowitz, John Ferro, and I are going to do everything we can to read up on what the strategists are doing and the nuances they're making. John, in your reading, what's the number one nuance you see into second half 2021?
The massive divide over 10-year yields and trying to call this FX market. I'll go over what I just said. On the equity side, we outperformed in Europe. On the FX side, we didn't. A lot of people were looking for that euro strength together, supplemented by that equity story, boosted by inflows. Tom, we haven't seen it in the way people thought it would play out. It just has not played out that way. And there is a huge divide still over what happens with treasuries. 195 at the one end, the call from JP Morgan, 1% at the other, the call from HSBC.
There's symbolism out there. Mr. Bro with us from Invesco yesterday, I thought was brilliant. And Lisa Abramowitz, it's maybe less talked about, but away from full faith and credit, the government paper is what the bond world is saying. And can we say, Lisa, it's never been like this?
Well, we we have record low yields, particularly in the U.S. high-yield bond space. The question is how indicative that is of a credit cycle versus simply central bank support. Just to give you a sense, though, of what has shifted in the past several weeks, it has been a reconfirmation of the market believing the Fed and believing other central bankers that any inflationary push is transitory. Just to give you a sense, just crossing the Bloomberg terminal, the German inflation rate fell to 2.1% in June, matching estimates, but really confirming this idea of a deceleration, Tom, at a time when a lot of people really don't have a crystal ball into inflation, to put it mildly.
You're channeling me, to say the least. John Farrow, I was going to go to you, but I wanted to get to Lisa to give her some FaceTime. But, you know, John, I'm looking at the negative yield on the German 10-year. John, the two of you, I mean, this is serious.
Well,
the negative yield on the German 10-year.
For a moment in time, we were pushing zero.
Yeah,
one week.
And it's
then
just come back.
And for a moment in time, everyone was all lathered up about this idea that inflation was going to spiral out of control. I'm not making a call on that, but when you look at market expectations of inflation, 10-year break-evens topped out in May, Lisa.
Yeah, and this to me is a question going forward, especially as you have these surveys that come out and that continually say that the biggest potential risk to markets is upside surprise in inflation, upside surprise to growth estimates.
Where is it? Where do we see it?
We're seeing that, Michael Darda of MKM Partners. We're not seeing it in the market, though, except for the reflation trades that, frankly, have cooled off in the past few weeks, Tom.
I mean, John, I don't see a higher inflation Bloomberg terminal screen. Do you?
Not right now. Here's what I see for the airlines. They've struggled this month. They've struggled this month, yet when you look at the corporate behavior, maybe that's the key indicator right now. Corporations are betting on a better future.
Totally agree.
United Airlines agreeing to buy 270 jets, believing that we go back to 100% return of business travel. There's a big bet in there, Tom.
The big bet in there is we're going to really focus on the earnings season as it breaks out here in 3 weeks or so. I don't know when that starts, John. You'll tell me when to wake up and start looking at J.P. Morgan. John, let's do the data right now. Red and green. We're not going to talk England, Germany now. We're going to do the data check, and we'll get to that in a moment. Red and green on the screen. I'm waiting for SPX to go positive with the Dow. John, it hasn't so far.
It hasn't yet, no. We're negative about 2 or 3 points on the S&P 500. 42.78 in the bond market, a break of 150, 148. And here's your date, Tom, July 13th. Okay?
July 13th, thank you. God, you're so fast. He's better at the terminal than I am.
I can talk and use the Bloomberg terminal.
That's amazing.
All at the same time.
I can't do that. Brent crude pulls back $76 back to $74.84. Let us get started. Michael Bell with us with J.P. Morgan Asset Management, global market strategist for EMA. Michael Bell, what is EMA? Explain that for our audience. It's not Global Wall Street. What is EMEA?
It's Europe, Middle East, and Africa.
Okay, it's Euro, Middle East, and Africa. We got Euro doing better. What about the rest of your territory? Is it a time for emerging markets to add value?
I think so, actually. I think that on a long-run view, EM looks pretty attractive. So particularly, though, we think within the EM, looking into Asia rather than at Africa, we think the long-term outlook for somewhere like India is really just quite spectacular. Obviously, they've got some challenges at the moment with COVID, but we think they'll come through that by next year. And then we're looking at growth rates, which are going to be well north of 6%, we think, on average over the next decade.
Mike, what do you make of this dollar call? It's been really difficult. Euro-dollar started the year, and that's where we topped out. The high of the year, first week of January, 123.27. We're rolling over again right now at 118.90, down a third of 1%. The equity call in Europe, that's the one that's played out quite nicely. We've had some outperformance in Europe versus the US. The FX call's been tough. Can you make the FX call now, Mike?
I guess the FX is more driven by rate expectations and what's going on with the economy. Obviously, the fact that the Delta variant is causing problems now in Europe means that it looks like we're probably going to miss another summer of international tourism for Europe, which is going to weigh on the economy there. But European companies, on the other hand, a lot of them have been really benefiting from absolutely booming global goods demand. And if you look at the sort of travel and leisure sector as a percentage weight of European markets, it's pretty small. So while it weighs on the economy, the market as a whole is doing a lot better.
We've been talking all morning about the Delta variant, the idea of how long does it take before this becomes a macro story versus, as John was pointing out, an idiosyncratic story affecting just the airline stocks and a number of other travel stocks. From the emerging markets perspective, when do you start to care a little bit more and start to get a little more defensive?
I think ultimately if it became a problem in China, and China's obviously such a large part of the emerging markets, At the moment, cases in China remain very, very low, and so that's positive for EM. India obviously has already suffered very significantly with the Delta variant, but cases there seem to have peaked, despite the fact that we're seeing a pickup in activity data in India. So we've got to watch that pretty carefully. But if you think India and China really are the bulk of EM, and at the moment it looks hopefully like we're past the worst for India, and that China doesn't have many cases. So I think it's if you started to see serious problems with the Delta variant in China that would be more worried.
Mike, you've made a really excellent point. In the equity market, travel and leisure stocks on a stock 600 make up a little more than 1% of the overall index. It's the smallest weighting on the index on a sector basis. But it's a part of the economy in Spain, in Italy, in Portugal. These are big chunks of economic output. Now, if you can't make that trade through the equity side, is there something you do on the sovereign side? Would you lighten up your exposure to the periphery at the moment, given what's playing out?
I don't think so, because I think they're pretty well supported, really, and that it's about missing one summer. So I don't think it's a major problem. It delays the point at which you get back to closed output gaps in places like Italy, places like Spain, for example. And as a result, probably delays the point at which people start to think about tightening from the ECB. And as a result, weighs on the euro, which is exactly what I think we're seeing. So I think it's more a kind of currency story than something to play through the sovereign market.
Let's talk about the FX market right now. Mike, we're going to let you go. Mike Bell, JP Morgan Asset Management. Thank you, sir. Dollar stronger, euro dollar down 1/3%, a break of 119 on the euro, 118 handle. Sterling weaker by 0.4%, and it's a proxy for global growth, global economic activity. The Aussie dollar, Tom Keane, down 0.6%. That's a weaker Aussie.
One of the first half things as well, John Konaheg mentioned in this earlier on soft commodities. Brazil has surprised and really come in with some Brazilian strength. And I look, this is within North America and it's oil infected as well. But Mexican peso nicely under 20. That's a change from where we were.
It has been so difficult to get this dollar called right.
I agree totally.
From the macro side, you'd be talking about an improving global economic backdrop. You'd be talking about reopening. And within that, you'd imagine, Lisa, that this weaker dollar story develops. Yet who would have thought that the weakest part of the dollar story was right at the beginning of the year?
And how about the connection to the fiscal deficit? The idea here that the more that the U.S. borrowed, supposedly, the more the dollar would weaken, people would go elsewhere. It would help juice economic growth. In fact, it's been the opposite, that we've seen it continue to hold in there, even as we see the potential for, what, a $6 trillion reconciliation bill alongside this $579 billion bipartisan agreement. I wonder at what point deficits matter, and if they don't, what are the longer-term implications, John?
10-year yields. I keep going back to this.
Yeah.
They topped out. Nominal 10-year yields topped out at the end of the first quarter. And all the arguments I hear now for high yields, the valuation case, the supply case, the story about the reaction function of the Fed allowing for more inflation, those three arguments all existed at the start of this year as well, Tom. Yet here we are at the halfway point of 2021, sub 150.
We're re-rationalizing wrapped around the elephant in the room, which is a boom economy that none of us have ever experienced. How can you take a price and yield analysis over to a what, John, 7-8% now economy, even 5% coming on economy?
I don't think you can with any accuracy.
Yeah.
Yet you can bet on the direction, and most people just assume directionally up and to the right. Higher, much higher, Lisa.
I don't know if it's a boom market, though. And this, I think, is a question. How much is this just simply spending that we didn't see last year in terms of services? And that really is something that we won't know until a couple of months from now.
Coming up on China, Mike Bell at JP Morgan mentioned the importance of what was taking place in China. We'll do that next with Leland Miller, China Beige Book International CEO. Your equity market unchanged at 42.79 from New York City this morning. Good morning to you all. Worldwide, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. President Biden will promote his infrastructure plan today in rural Wisconsin, where support for Donald Trump still runs deep. The president's proposal would have benefits for agriculture, and soaring exports to China are boosting corn, soybean, and wheat prices. Still, rural voters are wary of President Biden. Wisconsin is one of the states that will play a key role in the 2022 elections for control of the Senate. House Speaker Nancy Pelosi has moved to create a select committee to investigate the attack on the Capitol. The panel would have subpoena power and no deadline. Senate Republicans blocked creation of an independent commission. Legislation creating the committee would give Republicans 5 of the 13 seats. And it's a record purchase for United Airlines. The carriers agreed to buy 200 Boeing 737 MAX jets and 70 Airbus A321neo jets. The deal's valued at about $15 billion. Those new jets and other United's single-aisle planes will get a revamped cabin with seatback screens and larger overhead bins. It's a sign that United plans to step up competition for premium flyers with its two big U.S. rivals, Delta and American. And it's a milestone for Facebook. Shares of the social network rising after an antitrust victory helped push its market value above $1 trillion. Facebook's now the fastest company to reach that level. A judge granted its request to dismiss two complaints filed last year by the Federal Trade Commission and state attorneys general. And JP Morgan reportedly is boosting its pay for junior bankers. According to the UK's Financial News, the bank's now offering first-year analysts starting salaries of $100,000. Younger bankers on Wall Street have complained of longer hours due to the boom in M&A. Global news 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Just don't see the inflation we're seeing, the growth we're seeing, and the policy stance that we're seeing today as being sustainable. And in that respect, I think the future doesn't look quite as bright as the recent past.
That was James Athey, Aberdeen Standard Investments Senior Investment Manager from New York City this morning. Good morning. Alongside Tom Keane, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market this Tuesday morning. All-time highs just pulling back 0.25 points. We're off by 0.01%. In the bond market, yields are higher by about a basis point and change, 149.17. Dollar strength, the story through G10. Euro dollar, a break of 119 to the downside. Euro dollar 118.87. We're negative there, a third of 1%.
There's some movement, John. There's no other way to put it. I mean, there's some currency movement here. And again, this goes into important economic data. Again, to remind you, July 2 jobs report on Friday. Right now is arguably the most important interview we'll do this week on China. Leland Miller owns a franchise, his China Beige book, which is the granularity of China out of UVA. He simply owns the high ground on what is really going on in China. Leland Miller joins us here around the politics of China and also their economics. Leland, I want to just cut to the chase. What's our biggest misconception about China right now?
You know, I think the biggest misconception is the degree to which credit is really being strangled right now, and capex is down. I know it's consensus to understand that, you know, there's some deleveraging going on in China, but when you look at our quarterly credit results, I mean, you're seeing record lows in everything, all the big categories. Overall borrowing by state firms. If you look by geography, you're seeing enormously low, just numbers crater outside the big three regions of Shanghai, Beijing, and Guangdong. So it's hard for people, I think, to understand the degree to which China is really squeezing the credit, this credit spigot right now. This is not the deleveraging plans of the past.
Well, let's jump forward to the politics. You state clearly there's another false dawn for retail as well. How does that change the political domestic calculus for President Xi? If he's got credit challenges and he's got a retail false dawn, what does that mean for his politics?
Well, it's a real problem looking into 2022 when you're going to see the twice-a-decade party Congress. Right now, you've got a global recovery, and you've got China exporting and doing well with manufacturing, and so parts of the economy are going very, very well. So it's hard to see, you know, the true weakness in there because it's not hitting the overall numbers except in very specific places. But for any durable recovery, you're going to need a consumption recovery. You're going to need retail back. You're going to need services back. And these sectors are not doing well. And services hasn't done much since the end of 2020, and retail is actually looking worse than it did last quarter. So you're going to have to see a pickup in this, but how are you going to see a pickup if firms aren't able to borrow as much? So they've got some policy decisions to make come into this year.
And behind all of this is GDP, is annual growth. And you see the potential for negative growth in China should the credit impulse continue to be restricted the way that you've seen so far. Can you elaborate on just how much of a slowdown we could see?
Yeah, look, the GDP number can be whatever Beijing wants it to be, because literally they just let up on the credit spigots and the number will grow. And they won't have negative GDP. They'll have growth, but when you're plenty of growth. But when the problem here is that when you're looking at the numbers in a non-year-on-year fashion, you're not looking at the comparison from what happened during the immediate recovery from the coronavirus. You know, you start seeing clear numbers. And what's happened in 2021 has not been this dramatic pickup in growth. If you're looking at it month to month or quarter to quarter, everything is skewed by the year-on-year lens. So with the credit slowdown, the capex slowdown, these are really hitting growth numbers, but you don't see it as much in the GDP number because it's a year-on-year figure.
And one thing that you point out in the recent report is that fewer retailers have borrowed than at any time in the China Beige Book's history. Going forward, can you give us a sense of the why behind the restriction in credit? What is China trying to accomplish, and when will it start to ease up a little bit here?
Well, for years, I think that there's been an understanding in Beijing that they need to pull back on this extraordinary this stimulus all the time, everywhere type of mindset, where everything was backstop and firms weren't allowed to fail and products weren't allowed to default. And they're pulling back from that because I think that there's some real anxiety in Beijing that they're coming, you know, they're maybe not at the end of the line, but they're nearing the end of the line of being able to do this. In the West, everyone believes China can just stimulate forever. In Beijing, there's more anxiety already. So they're going to have to figure out how much of a slowdown they can stomach, particularly going into an important political year like 2022. They're doing it now. They're riding a global recovery. But the end of this year is going to make for some very, very interesting policy decisions because they've got to go one way or the other.
Leland, what do you see in Hong Kong? What's the beige book of Hong Kong? And what is your counsel to major Western banks?
Well, we don't track growth as part of China Beige Book. We don't track Hong Kong as part of the China Beige Book overall survey. But I think what's happening in Hong Kong is pretty clear. There's a huge crackdown. This is becoming China. It's not the Hong Kong of old. And so businesses that can cater to a purely Chinese audience or have business inside Hong Kong, they can stay and do well. But I think the idea that Hong Kong is this international center of commerce, that's just not true anymore. And it's going to get worse and worse as the authorities use the national security law to just weed out any evidence of dissent or any evidence of pushback against the Communist Party back in the mainland.
Leland Miller of the China Beige Book, the international CEO. Great to catch up, Leland. As always, thank you, sir. Just getting some more details on a credit call from Morgan Stanley that I want to bring you guys. Lisa, I think you'll be interested in this one. Quote, vulnerable to a negative surprise. That's what credit is right now. The probability of a taper tantrum style move in real yields has risen in light of the Fed's change in rhetoric.
What I love about this, a negative surprise with respect to tapering, perhaps not a negative surprise when it comes to economic growth, because the only way they could start talking about taper is if you get a positive read on inflation, on jobs growth. So it's sort of negative surprise, perhaps, when it comes to tapering.
Go on, Tom.
What's the summary? Higher yields, lower prices?
Wider spreads by about 15 to 25 basis points, which might not sound like a lot, but for investment grade right now, the spread as of yesterday, just a little north of 80 basis points. So 15 to 25 would be material given where we are trading at the moment.
So what's it mean? I want to own the belly of the curve?
They're saying do not have a look at IG credit, but we could be vulnerable there, Tom. It's not a treasury call, it's a credit market call.
Sorry.
If you are talking about the belly of treasuries, that
the
is.
belly of the curve.
You want to talk about bellies?
Or something else.
Look, honestly, though, I have to wonder what indication have any Fed officials, at least those at the top, what have they given that they're actually willing to start talking about tapering in the near future?
Well, good question. What have we heard?
Well, from the core of the Fed, not the same thing as the likes of Bostic, Rosengren, Bullard and Kaplan. The core of the Fed is still pushing back against all of this.
I mean, John, I think we got to look at the economic data coming out. We got ADP tomorrow, what that's worth. But there's a lot of stuff here. I mean,
payrolls on
first
Friday.
of the month, ISM and all that. We're going to be smarter Friday at 8:32.
Well, are we?
I was about to say the same thing.
Are we? I hope we are. But maybe, the last couple of jobs report have asked more questions than they've answered. And that's been the issue, hasn't it?
I just nailed the one two ago. Absolutely crushed that one.
Matt Lazzetti's going to join us soon.
I think I was off by 6 zeros.
From New York. This is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City, live on TV and radio, this is Bloomberg Surveillance for our audience worldwide, alongside Tom Keene and Lisa Browitz. I'm Jonathan Ferro. 8:30 New York time, 1 hour away from the open, and Bell equities coming into Tuesday at record highs on the S&P right now, 4280, totally unchanged. And I have to say, since we came in and around 4:30 Eastern time, I think Lisa gets in first, then Tom and I compete for who comes in last. We have not been moving on S&P 500 futures. Yields right now 149.85, a bit of a lift there by a little more than 2 basis points. In the FX market, euro dollar is where you see the price action. In fact, through FX in G10, the euro's weaker, the dollar's stronger. Euro dollar a break of 119 at 118.87.
My tendency, John, is we're higher. We're higher today. I mean, Dow futures green and SPX, we get green for a bit and then the other way, and we'll see. And it's the economic data. 9 o'clock, we get that housing data, John. I'm sorry, it's important. It's part of America.
And then on to payrolls. ADP, the appetizer before the main course. Your main course, the estimate there, 700K.
Claims as well as maybe the most elegant chart out there. Right now, to make us smarter, Matthew Lazzetti with us for you on Global Wall Street. Deutsche Bank has just done a terrific job. It's maybe a fractious view with a different view short term versus their view long term. Let's go wicked short to Friday with Matthew Lazzetti, our first real discussion of his jobs report. Matthew, I love what you say. It is a perplexing labor economy. How will this Friday's report be perplexing?
Sure. Thank you for having me. I think what we've seen over the past several months is data points which are pointing at two different things. We have an economy which on a number of metrics looks like there's a lot of slack. 7.6 million jobs below pre-COVID, a labor force that's 3.5 million below pre-COVID as well. On the other hand, you have record quits, record job openings, wages have been firm. And so I think we've been looking for data points to try to resolve these two issues in our mind. And I know the Fed is certainly looking at data points there. I don't think we get a resolution this week. We expect 700,000 jobs. We expect the unemployment rate to tick down by 1/10, the labor force to pick up a little bit. But I think, as Fed officials have said, it's more likely that we have to wait until the fall till we get labor supply coming on fully and get a greater resolution of this real dichotomy that we're seeing in the labor market.
That February, before the pandemic, we all look back at that nirvana of what was billed as a fully employed America. Is that what we're going back to, or are we going forward to something new and different?
Look, I think there's definitely some things that have changed, and probably from a structural sense. And the Fed and Chair Powell has talked about retirements really picking up probably on the back of a big pickup in wealth and savings that households have had there. But in my mind, what we learned from the pre-COVID labor market was we just continually found labor supply. The prime age labor force participation rate continued to trend higher, people coming off disability insurance rolls. Vice Chair Clarida at that point was saying that NAIRU could be as low as 3.5%. And I don't think that there's anything from this shock that prevents us from getting back there. If anything, greater workforce flexibility, some of these policies that the Biden administration is looking at should help to lift labor supply. So there is no doubt constraints in the near term on labor supply. But if we look forward by a year, 2 years, I think that we should anticipate that we can get back to that pre-COVID labor market.
Matt, some people have made the argument that holding back labor supply, one factor behind that has been the additional unemployment insurance. You make the argument, you find limited evidence that enhanced unemployment insurance benefits were exerting a material drag on aggregate employment. What did you look at, Matt?
Sure. So I know there's been a lot of look at the work done on this. And what we've looked at is try to look across states, try to look across sectors. And are you seeing labor markets either in low-wage states that look like they are more constrained because they should be more impacted by enhanced unemployment benefits? Are you seeing low-wage sectors that are also being more constrained? And you really don't find that. So, for example, leisure and hospitality, we looked at the vacancy yield, and this is the rate at which you're turning job openings into hires. The vacancy yield in leisure and hospitality, which is a low-wage sector, is actually well above a lot of high-wage sectors. Similarly, if you look at across states, it's actually the low-wage states that are really outperforming here. It's the high-wage states that still have a lot of slack or well below pre-COVID levels. So in our mind, unemployment insurance benefits, no doubt, I would not deny that it is probably a factor for some. But if you look at the big macro stories, in my mind, it's COVID, and it's really not unemployment insurance benefits.
Is the return to school part of the COVID story? So two things happen in September. The additional UI expires and the schools reopen, hopefully, and everyone gets to go back to school, Matt. Do you think that could be the dominant factor here?
Absolutely. I think you have the direct effect of that in reopening, which is just getting greater education and employment. But on the other hand, it opens up labor supply to an extent that we haven't seen as of yet. So I think in the debates that we have with clients on this, there's a very forceful debate on both sides. But we all kind of end up in a place where once we get to the fall, as vaccinations have picked up, as schools reopen, as unemployment insurance benefits roll off, all of those things should really lead to a lift in labor supply as we get towards the fall.
Yet we haven't seen as much progress in the labor market as many people had expected. And yes, we have to wait. But at what point will you rethink your goals in terms of getting the unemployment rate back down to where it was, and frankly, getting the participation rate higher? I mean, what is concerning you and keeping you up at night with respect to this?
Yeah, I think the lack of response from labor force participation has certainly been one of them. The trend that we've seen in employment gains has been weaker than we anticipated. There's an interesting, if you look at the non-seasonally adjusted data, we've been printing about 1 million jobs per month on average over the past 4 months, a very steady pace. And Chair Powell noted this. There may just be speed limits on how quickly we can rehire people into this economy. And maybe it's 1 million jobs per month on a non-seasonally adjusted basis. Indeed has some great data looking at a really big pickup in job postings for HR departments. And so maybe this is businesses trying to get around this natural speed limit. In any event, as if we continue to print those types of non-seasonally adjusted jobs, it'll get a boost over the next few months. So with the labor demand that we have out there, as labor supply does normalize, I anticipate that our bullish outlook for the labor market should really be fulfilled as we get towards the end of this year and then as we get into next year.
A lot of people talk about the frictions in the labor market as leading to a lot of wage increases. How persistent, how much has the balance shifted back to labor from corporations in terms of demanding higher wages?
Yeah, I think you're seeing different views from different wage numbers. So the Atlanta Fed's wage metrics have actually decelerated in a broad way, and they're tracking individuals over time. So they're able to control for a lot of different compositional shifts. The average hourly earnings data that we'll get on Friday, it's just skewed by so many compositional issues. They don't control for occupation or sectoral shifts. So it's really difficult to read too much into those data. We have to wait for the employment cost index to come out each quarter. But what I would say there is no doubt you're seeing wage pressures, I think, in a number of metrics now, certainly a lot of anecdotes, and labor supply is constrained at this point. But if I go back to what I said before, I'd be very surprised if we go back, if we look forward by a year, 2 years, and we're still seeing these same constraints there. I think on the contrary, we should be back towards a pre-COVID labor market where we are really unleashing significant labor supply, and that I think keeps price pressures in check, keeps wage pressures in check as well.
So what is your unemployment rate that is a mental tip point? You know, the Deutsche Bank research of Folkers, Landau, and Hooper worried about inflation out 3 and 4 years, and yet a short-term view that's very much different than that. Can we use a tip point of unemployment rate as a signal that we're back to where we're supposed to be?
Yeah, and I should be clear, you know, we have a baseline view that the inflation jump that this year is transitory, and I think there's good reasons for that. But, you know, we completely agree that the risks are very clearly skewed to the upside, given substantial fiscal stimulus that we've seen, given this regime shift from the Fed. It's really unprecedented. So I completely agree that the risks are to the upside. Specifically to your point, you know, identifying NAIRU pre-COVID was almost impossible. As I mentioned, Vice Chair Clarida had said NAIRU could be as low as 3.5%. In fact, we never really found it.
Yeah, he said that to John, not to me.
You know, I would agree with that assessment at that point in time, which was we never really found it. You know, we tried to do state level analysis. Where could you see a nonlinear Phillips curve kick in? And the evidence was you really need to see the unemployment rate drop to very low levels, you know, low 3% perhaps, 1 percentage point or more below what people thought NAIRU was. So my takeaway from the pre-COVID economy was we did not find NAIRU. We could not find, you know, where full employment was. And I think the Fed, that was their big takeaway from their policy review that they had, which was you really could get broad-based gains. The Phillips curve really flattened, and NAIRU was probably lower than they always anticipated.
So, Matt, let's finish on this. You've just painted this picture of a world that we won't see more clearly until the end of the year, which is basically the fall, my autumn, your fall, September, October time. Why would the Federal Reserve make an announcement on the reduction of asset purchases until they've seen that data?
Yeah, so I think there's two things. One, the significant demand that they see in the labor market, record job openings, you know, all the different survey indicators give them a lot of confidence that if supply does become unleashed, the demand is there to see substantial further progress in the labor market. So I think that's an important data point. The second is this risk management. And, you know, we agree that there is just substantial upside risk to inflation, even though I believe in the baseline transitory story. And because there is, you know, a process here of, you know, beginning the tapering process, drawing down to net zero asset purchases, raising interest rates, given the growth outlook, given the labor market outlook, it probably does make sense to start that process. And again, they'll say that it's not tightening, it's just pulling back on some of the accommodation that they have. So I think by the end of the year, given our outlook, they should start that process. I think they will start that process. And we have them announcing tapering in December.
In December. Okay. Matt Lazzetti with the December call. Deutsche Bank chief U.S. economist. Coming up in the next hour on The Open, we'll catch up with Canaccord Genuity chief market strategist Tony Dwyer. Tom Keene, looking at this market right now, your Dow's up nicely, up 1/3 of 1%. I believe that's because Boeing's doing okay in the pre-market.
Yeah, John, it's noise.
Is that helping out?
It's noise. I mean, the VIX.
The Dow's noise.
I look at the VIX, 15.44. And the VIX didn't really go yesterday.
42.80 on the S&P 500. Yields higher by almost 3 basis points now, Lisa. Back through 150.
Oh.
Yeah, I just wonder what will keep going up, what will keep that yield going up, how much this really hinges on perhaps a better than expected labor report on Friday, or if it can continue without that.
Yields are high, dollar stronger. That's your theme this morning. Yields are up by 2-3 basis points on a 10-year yield. Euro dollar down to 118.82. Dollar stronger through G10. Outside of that, this equity market on the S&P at the headline level has been a snooze now for hours and hours and hours. We go nowhere. Alongside Tom Keene. Lisa Brabitz, I'm Jonathan Ferro. I'm going somewhere. I'm going to go away. I'm going to do The Open on TV. Tom will do that on radio. Lisa will take a break. 42.79. Take a break to read and then come in really early at 3:30 to make us all look bad. 42.79 on the S&P. Let's call it 42.80. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. On Capitol Hill, the House has passed its own version of legislation aimed at boosting research and development in response to China. The Senate passed similar legislation, although its version includes incentives for semiconductor makers. The two chambers will have to negotiate the differences. The American father and son who helped auto exec Carlos Ghosn escape trial in Japan have apologized. Michael and Peter Taylor told a Japanese court that they made a mistake that they deeply regret. The two could get a 3-year prison term. They were extradited from the U.S. earlier this year. JP Morgan CEO Jamie Dimon says that Paris has become the bank's main trading center in Europe. Dimon spoke at the inauguration of JP Morgan's new headquarters in the French capital today. He told reporters that all European trading will go through the facility. JP Morgan says 140 employees have moved to Paris in the wake of Brexit. Bloomberg's learned that the Justice Department has stepped up scrutiny of Google's digital and ad practices in recent months. That shows the Biden administration is pursuing an antitrust probe that started under former President Trump. The Justice Department sued Google last year, saying it was abusing its dominance in internet search. And in the UK, house prices grew at their fastest annual pace in more than 17 years this month. That's adding to a growing wealth gap that has policymakers worried. According to Nationwide Building Society, property prices rose 13.4% from a year ago. The average price is now $353,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
every day that goes by, it's clearer to me and to all our advisors, all our scientific advisors, that we're very likely to be in a position on July the 19th to say that that really is the terminus, and we can go back to life as it was before COVID as far as possible.
The Prime Minister of the United Kingdom, he will be focused on a small soccer match this afternoon between England. John Farrow chastising me. It is not Britain, it is England that is playing. England versus Germany. Lisa Bramowitz will have a full report for you here.
Oh, yeah.
In about an hour. Lisa Bramowitz and Tom Keene here. And right now, we're going to do a public service. One B. Ritholtz will join us. He's with Bloomberg Opinion, writing on any number of things. And Barry, seriously, I want to do this in that there's the year-end review, and we all look at them, and we all can line up sort of kind of like what we got wrong 6 months ago. And now we enjoy the mid-year correction, the mid-year adjustment, the mid-year outlook. How do you read a mid-year outlook, even it comes off the pen of Barry Ritholtz?
Yeah, you're not going to like my answer. Years and quarters and other than earnings report, those are astronomical terms, not finance terms. The calendar year, the first half of the year, they're meaningless other than, well, July 1st is Bobby Bonilla Day for the Mets. But other than that, you know, you just assume that whatever the previous trend that was in effect is continuing. Markets don't care about the flip of the calendar, whether it's a month, a half year, or a year. And by the way, this is actually a serious issue because investors have a tendency to get really wrapped up in these sort of things, and sometimes it forces or gives them an excuse to make ill-advised changes because of the calendar.
It was important here, Barry, and I'm in the camp that they're literally marketing efforts. I mean, to be completely cynical about it, folks, and we've all been involved with this as well. But if you have to look at a given marketing effort, how do you actually look at a 12-page report?
So two ways. First, I look at the process that the analyst or strategist or whoever uses. And then second, I look at how successful that process has been historically. I know you can't only rely on track record and performance, but at least it provides some insight into, hey, does this strategy have any resonance, at least within the current market regime and what seems to be mattering right now to traders and investors?
It's unclear to me, Barry, what your perspective could be based on the fact that the index level has been a churn. It's been a snoozer, to quote John Farrow, and yet under the surface, there have been huge outperformances and underperformances, and we have a lot of investors coming on and saying it's time to pick stocks. Do you agree, or do you stick with indexing strategies because it's too difficult to get the right stocks correctly?
It's time to pick stocks. Well, there's only a bajillion academic papers that say, with very few exceptions, stock pickers over time underperform, and that's before we work in our cost structure of paying for that. Look, I don't mind if people want to have a fun portfolio and take 5%, 10% of their real money and play around with it. If you want to buy anything from Apple to Bitcoin to Netflix to whatever, hey, have fun with it, but recognize the odds are just so weighted against you. Not only is it difficult to pick stocks, it's difficult to pick the people who are good at picking stocks and do so on a cost-efficient basis.
Barry, the reason why I bring this up is because an increasing number of people say this time is different, certainly when it comes to sectors, if not specific stocks. Is this time different based on some of the churn, the rotation, the reflation narrative that's gaining and waning as time goes on?
So, you know, that's a really interesting phrase, and I think people don't understand what it means. First, this time is always different. The world is always changing. We learn, go back to Soros's convexity. Markets learn from their past experiences. But what that phrase means is when investors and traders rationalize wildly expensive assets in order to say, hey, we're not just paying for a PE, we're paying for clicks and eyeballs, or we're paying for the scarcity of crypto and the collapse of fiat currency, and that's what's unique. That's what this time is different means. It always refers to the fact that human nature is unchanging. That said, this is a really unique environment. It's hard to find a post-pandemic massive monetary stimulus, massive fiscal stimulus. And so there are going to be winners and losers, and there will clearly be stock pickers who will identify the right companies in the right sectors. It's just really hard to do. And P.S., it's really hard to know when to jump off that train.
Barry,
people are better buyers than sellers. That's the big takeaway among stock
Barry, we got breaking news. We've got to leave right now. Barry Ritholtz, thank you so much on the mid-year outlook. Lisa, this is an exceptionally important small release from Moderna. It is a detailed press release, not a normal press release, and it's literally, Lisa, around a sample of 8 individuals, 8 participants obtained 1 week after a second dose of the virus around a set of variants, including the Delta India variant.
The idea here is, do vaccines prevent you from getting sick or prevent you at least from getting seriously ill from some of these more virulent, potentially, variants, including the Delta variant, which has been, I believe, the most contagious to date. The data coming in saying, yes, it does, despite some studies showing that people did have some breakthrough infections in Israel, in California, who had already been vaccinated to the Delta variant. Again, this just highlights the diversion between the haves and the have-nots when it comes to vaccinations. The people who have gotten vaccinated, by and large, are protected, at least by these particular vaccines, and that's the data showing again and again and again. And this becomes a question of what do you do with people who are not vaccinated? At what point do you mandate vaccination? How much do you protect them from a public health standpoint?
And not only India is mentioned, but I want to be careful here, folks, because the press release is very, very technical. It involves the United Kingdom and the Alpha virus, the Republic of South Africa, and I believe, Lisa, Angola is mentioned as well. It's really a detailed effort of one of the great success stories here to get on this story right now.
Can I just tell you one of the stories that I thought was most fascinating in the past 48 hours out of the New York Times, showing that Pfizer and Moderna vaccines do not necessarily require a booster shot. That so far, it seems like they provoke an immune response that lasts years. This is a sea change. I mean, this actually, again, this should be optimistic if it weren't for the variant that's spreading so significantly in so many places.
But what we've heard from the pros is there's always variants. It's just dealing with them. And clearly we heard from Amesh Adalja of Johns Hopkins today, the virulence in the, I'm going to use an amateur word, the infectability of the Delta variant.
Is that a word?
I don't think it is, but I'll go with it.
I think it's good. I think it's good. Contagiousness.
Virology as well. We have a persistence to the market. S&P futures, at least for the moment, flat. Dow futures green. NASDAQ goes the other way, but all of this fractional. The major observation today is dollar strength, not a breakout, but we'll go with it. And the euro breaching a 119, weaker 118.81. Coming up, a conversation with Mayor Bowser of Washington, D.C. Stay with us on radio and television.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. 30 minutes until the opening bell in New York, with equities coming into Tuesday at record highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, COVID variants clouding the outlook.
The Delta variant. The Delta variant, the spread of the Delta variant.
The Delta variant is going to be an issue.
Definitely, it is right now the key tail risk to watch.
The risk is there. It's the major visible risk.
And it could potentially derail things.
The travel restrictions are still in place in many countries.
That can open the pathway for lockdowns later.
Economic growth forecasts could roll over.
But the issue is that the central bank's responsibility is also for looking at the economy and inflation.
This is the risk that we all have, on our radar, right? The Fed crunching the recovery.
That's still the big uncertainty.
Central banks have to calibrate very, very carefully.
Joining us now, Federated's Debbie Cunningham and Peter Yee of Northern Trust. Debbie, I want to start right there. It's a tail risk, it's not the base case. I just want to understand how you approach this situation with this variant that seems to be troubling some countries at the moment.
Well, at this point, we're looking at it as a major risk, but one that has a low probability. So, it is not the dominant factor that is, behind how we're positioning our portfolios at this point. Having said that, if it starts to become more prevalent, it seems to be most prevalent in either non-vaccinated countries, or for those countries that are vaccinated, the impact of it is such that it's not resulting in nearly the amount of deaths and hospitalizations. However, those statistics are what we continue to monitor to make sure that, in fact, what we have, sort of built into our portfolio considerations of a pretty strong global recovery aren't derailed. And, we think that it's again, a low probability, but definitely the highest risk that's out there.
Peter Yee, as Debbie says, major risk, low probability. Do you agree?
We do agree. We think this is going to kind of go in fits and starts for a little bit. And these variants can certainly be, they can mutate even further. And our expectation is every year we may see booster shots that are going to be necessary just to keep things contained. So we do think it is a risk, but it is a little bit of a lower probability that we're going to have anything like we saw in 2020.
There are some cracks in this quick cyclical story, though, and we see those cracks in the airlines. In a pre-market and both over the last month, over the last 30 days, American, United, Delta, all down anywhere between 9.5% and almost 12%. We heard from the United Airlines CEO this morning. He said business travel is going to come back at 100%, and everything we see every week is making us more certain. They're betting with their own money. They're agreeing to buy another 270 jets. Now, that's the outlook from the airline business at the moment, Debbie. The equities are struggling over the last 30 days, and clearly the C-suite is still confident about the future. What I've been trying to understand is I see some cracks in the cyclical story in both the airlines and the banks. What it would take for this to be a broader macro story that would start to infect your world? Short duration, the front end of the yield curve.
Well, I think what you have to see to impact the short duration market is something that would result in shutdowns again from a global economic recovery standpoint. So right now, as I said, from an airline standpoint, expectations would be that leisure travel continues to grow. I think we're at over 2 million passengers per day, which is, pre-pandemic level, but certainly not from a business standpoint. I'm a business traveler that has traditionally gone on 3 or 4 business trips per month, one per week. I have only been on one in the last 16 months. That's a pretty drastic change. Now, I certainly expect that over the course of this summer, I have various trips planned. They will occur, and there will be more that kind of build up on that calendar. Having said that, I don't think it will ever go back to, or at least not in the near term, pre-pandemic level, because what we've learned during the pandemic is the fact that you can accomplish a lot without getting on an airplane. You can accomplish a lot without sitting face to face in front of people. Now, maybe that's what you need to close transactions and to further relationships, but it's not 100% necessary for every single meeting. So I do believe that we'll continue, to monitor how the pent-up demand is being satisfied for both business and leisure travel, and the impact on the short-term market sectors is basically, back to an inflationary type of story.
Peter Yee, can I ask the same question of you?
Yeah, we think there is pent-up demand in terms of travel. For the last year and a half, a lot of people have been just afraid of what the travel may look like in terms of potential spreading of the infections, but a lot of that has largely been lifted as more vaccinations are being rolled out. We certainly think that travelers are going to be confident again, especially business travelers, because there is a need to start seeing clients again. There is a need for a little more face-to-face interaction. But I would agree that I don't think we're going to go back to where we were even a year and a half ago. We think that technology has certainly proven that you can be just as effective using certain virtual platforms, and that may not necessitate a trip out to a sea client.
Well, these issues aren't holding back the Fed hawks either. This was Richmond Fed President Tom Barkin seeing a rate hike as early as next year, saying the following: it's pretty clear to me that we've had substantial further progress on the Fed's inflation goal, and the labour market might get there in short order. For more, let's bring in Bloomberg's Michael McKee. Morning, Mike.
Good morning, John. It's important to keep in mind that Tom Barkin also said if inflation doesn't rise, then we won't have to raise rates next year. But the inflation headline is the one that scares the markets. And here's what's going on with that right now. The Fed does not want the markets to think it is asleep on the job. That's why it's trying to keep a middle ground look at inflation going forward. You can see there that inflation, yes, is running hotter than the Fed forecast for the end of the year, but the red line is the average. And remember, they want to get that average up to 2%. And keep it over it for a little bit. So they want the markets to know we're watching, but we're not worried yet. Now, one of the things they're watching is home prices. We just got the latest home price numbers from the FHFA, up 1.8% on the month, more than expected. And look at this, the Case-Shiller Index, the U.S. average up 14.6% in April. That is the highest ever in the history of that index. But on the other hand, we're not seeing a lot of inflation out of that. The white line there is the inflation rate for owner equivalent rent in the CPI. Does it translate? That's something they're going to keep an eye on. And that leads into the other debate for the Fed that's been in the news this week. Should they taper mortgage bond buying? Because you look at what's happened with their mortgage bonds, $40 billion a month, and you can see pending home sales there have skyrocketed. Is the Fed creating a price bubble. That's been a debate, and we've seen that some of the Fed officials, including Jim Bullard and Rob Kaplan, and just recently Eric Rosengren, saying maybe we should start tapering that first. So that's something to keep in mind going forward. Is the Fed going to change the timing of tapering, but only for part of it?
Mike, when you and I spoke to the Fed president of New York, Mr. Williams, President Williams was talking about maybe avoiding that conversation altogether and just focusing on the broader signaling of just the total package. Who wins out here?
Well, right now it would appear the center is where John Williams is, and his argument and others there is that the overall bond buying, whether it's treasuries or mortgages, are pushing down borrowing costs across the board, including for corporates. So at this point, there doesn't seem to be a majority for it, but it is a discussion that's bubbling up.
Mike, thank you. Debbie, let me turn to you on that question. The data we're seeing in the housing market in the United States is really firm. Some might call it explosive, really, really strong. Do you think that influences a decision when it comes to the composition of the asset purchase program, QE, over at the Fed?
It's such a debate at this point. I do believe that the tapering and the announcement of it and the clarity around it will gain ground in the second half of 2021. I think there's a little bit of a focus on the debt ceiling, and once we're past that August 1st timeframe for that, this becomes the main event, and clarity around the types of tapering and the timing of tapering becomes a little bit more clear at that point. I do think there is a market that can exist and support itself without Fed intervention, certainly for treasuries and for mortgages. So I think that the potential for cutting back in proportion to how they have supported would make a lot of sense at this point, and seems to be something that, again, on a middle ground basis, might satisfy, New York's Williams and Boston's Rosengren.
Peter, when it comes to the discussion you're having at Northern Trust, what does that sound like right now with regards to the reduction of asset purchases, perhaps at the end of this year?
Yeah, we think we know the Fed is now talking about tapering, but we think the Fed is going to be very slow and is going to look for some of these unprecedented, reopening dynamics and see how they all kind of play out, as well as just the front-loaded fiscal stimulus. Our view is it's going to take some time, and the Fed is willing to wait. So our expectation on timing is likely that tapering is going to happen in 2022, more likely in the middle rather than the beginning of next year.
Peter Yee, alongside Debbie Cunningham. Guys, going to be sticking with me going into the opening bell. Equity futures unchanged on the S&P. At a market desk with your movers, here's Abby.
John, let's start out with the big banks because we do have some green on the screen, especially for Morgan Stanley and Goldman Sachs. This, of course, after last week, the big banks did pass those Fed stress tests. Yesterday, the news came out what the payouts would look like, and these two banks in particular really boosting the incentives for investors in a big way. Morgan Stanley doubling its dividend to 70 cents per share on a quarterly basis, also increasing the buyback to $12 billion. Goldman Sachs' dividend has been raised to $2 from $1.25. So we see some, again, nice gains there. As for some of the other banks, JP Morgan, Citigroup, Bank of America, a little bit more of a mixed picture here. JP Morgan, they have raised their quarterly dividend by 10 cents. They're continuing the repurchase program. Citi is continuing the dividend, and Bank of America is up, has increased their quarterly dividend to up 17% to 21 cents per share. And then rounding it out, John, heading away from financials to technology. Actually, this is a communication services company. Facebook now popping up slightly. It had been down earlier. This, of course, after they have won a dismissal of the monopoly lawsuits from the U.S. and states, a blow to the effort to break up the company. The FTC complaint, according to the judge, too vague. But John, this has been going on for years, these sorts of cases. Let's see what happens as time goes on. It seems as though there is an effort to try to break up these big tech companies. Unsuccessful so far.
356.29 on Facebook. Abby, thank you. Coming up, we'll head to D.C. We'll hear what Senate Minority Leader Mitch McConnell has to say about the infrastructure spending effort down in Washington. From New York City, for our audience worldwide, about 17 minutes away from the opening bell, 42.81 on S&P 500 futures. All-time highs coming into Tuesday. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Let me say there is bipartisan support for a significant infrastructure package. But we've had some big differences this year about what the country needs at this particular stage post-pandemic. And the first big disagreement was the American Rescue Package, another $2 trillion. And now we're confronted with an administration that would like to spend $5 trillion more. That is wildly out of proportion to what the country needs.
Senate Minority Leader Mitch McConnell pushing back against some of the big spending plans developing down in Washington, D.C. The Senator Chris Murphy responding in a tweet, writing the following: Mitch McConnell's all-consuming motivation is to stop anything from passing when Democrats are in control. For more, let's bring in Bloomberg's Anne-Marie Hordern down in D.C. Morning, Anne-Marie.
Morning, John. Yeah, what Mitch McConnell here, the Senate Minority Leader, is really pushing for is a separation of what the Democrats are calling this two-track, working in tandem to pass the bipartisan infrastructure deal that the White House worked with a group of senators on versus the larger tax increases and spending plans that the Democrats are pushing for via reconciliation. Now, Mitch McConnell, we should note, has yet, when he was speaking yesterday, endorsed this plan himself. He said he wants to look at exactly what the spending is called for in the bipartisan deal and if it's credible. But to Senator Murphy's point, if you are in Senator McConnell's position, we are just ahead of the 2022 midterm elections, and potentially a political play is, do you want to give this administration a win? A bipartisan infrastructure deal would give this administration a win. So if he is going to endorse that and give that a nod, he is going to make it very, very difficult for the Democrats to get their real win, which is that human infrastructure, larger taxes, and spending on things like child care and Medicare and the likes.
I understand the president leaves the White House at 10 Eastern, so in about 40 minutes or so, 43 minutes to be precise. Anne-Marie, then he speaks at about 2 Eastern in Wisconsin. Have you got any insight whatsoever on what the argument looks like a little bit later this afternoon from the president?
He's really there, John, to just drum up support for his infrastructure spending. And also, remember, he is going to really Republican land, Trump land. And he wants to say, listen, I brought this infrastructure deal to parts of rural parts of the country. A lot of that has to do with bringing broadband support to these communities, and also transportation in terms of the more produce and crops they have, being able to really transport that around the country and showing that he is working for them. And this is a large Republican base. Also, John, Wisconsin is a place the Democrats may have their eyes on flipping. Last month, Senator Ron Johnson said he hasn't decided yet if he is going to run. So this is a place that they seem that they want to get in early, but really it is to drum up support in this rural baseland. And I have to say, though, if you're entering the dairyland world of America, he's going at a good time, given what we've seen in terms of the agricultural space and the spike we've seen in some of these food prices.
Anne-Marie, it's good to see you down in Washington, D.C. Washington correspondent Anne-Marie Hordern there, thank you. Let's pull up the bond market just briefly. Got a 10-year yield now just about south of 150, pushing 150 up 2 basis points on the day. A 30-year yield up a couple of basis points to 2.11% on the day. On the year, the highs for the 10-year. How many times have I said this over the last couple of months? We topped out at the end of March, approaching 180. We haven't been there since. We topped out at the end of the first quarter. And the argument I'm hearing for high yields now is very similar to the argument I was hearing at the start of the year. JP Morgan making the point they'd be short the 10-year, they'd be targeting 195, valuations are rich, supply will remain heavy, the dovish stance over at the Federal Reserve should accommodate higher inflation, and yet here we are, sub 150. Let's bring in Federated's Debbie Cunningham and Peter Yee of Northern Trust for more. Peter Yee, why? I've gone through the argument, you're all familiar with it. Why are we still sub 150 on a 10-year, Pete?
Well, I think investors are just a little skeptical in terms of what happens after all this front-loaded pent-up demand and stimulus kind of smooths out. Chairman Powell has been very consistent in saying some of the inflation metrics are transitory, and we believe that's the case just thinking about, the base effects as well as, the supply chain bottlenecks. And so we think that the Fed just continues to articulate a very slow and calculated approach. And, the 10-year at 150 is exactly where our central tendency forecast is for the next 6 months. We think it'll likely trade range bound between 125 and 175. And it's just going to take a lot of time for some of these distortions in the economic data to really just kind of smooth out and get a baseline.
Debbie, your thoughts, please.
Well, I think after the change in the Fed's economic projections from the June meeting, after the June FOMC meeting, and what we saw from a dot plot change with various members moving forward their projections for when the Fed would actually start to act. I actually think the bond market vigilantes are taking some solace in what they now believe to be a Fed that's paying attention to these factors. Peter may be absolutely right that, in fact, transitory is not long-term. And in fact, we end up being range-bound because transitory starts to smooth back out again and inflation starts to come down. But in fact, I think there's, the other side of the story as well, where the dot plot itself gave some solace to the bond market that, allowed them to not necessarily trade off in what has been an increasing inflation picture. I think one other thing that they're taking into consideration is, the dual mandate, the second mandate from a Fed standpoint, that being employment not being as strong. But from our standpoint, we think there's a couple reasons for that will go away fairly quickly. Number one, employment benefits are ceasing. And so we're going to have more people that have chosen to just, stay on the unemployment benefits as long as they could, go out into the job market and actively start seeking. I also think there's probably some mismatch in the availability of those to be hired versus the need for those that are hiring. And, the capabilities are not necessarily matched real well. So that might indicate even more inflation going forward with improving conditions in that unemployment marketplace. So we'll continue to monitor it. But there's, I think, a couple different reasons that might explain why, the 2-year and the 5-year acted drastically different following the front end and the technical adjustments versus what the long end in the 10 and 30-year did following more expectations for Fed action in the future.
It's a good point. Debbie, got to leave it there. It's always good to catch up. Debbie Cunningham there and Peter Yee. In your bond market, yields in and around 150. On Friday, we get some payrolls data. Payrolls Friday just around the corner. Coming up in the morning calls and later, the big banks announcing payout plans after getting the green light from the Fed. That conversation still ahead with BlackRock's Tony DeSpirito and Crossmark's Bob Dole. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. The world is possible.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
5 minutes away from the opening bell in New York City this morning. Good morning. All-time highs coming into Tuesday. We look to advance that by about 0.1% going into the cash open. That's the price action here at the morning calls. Your first one from Morgan Stanley upgrading Textron to overweight. Street high $87 price target. The analyst seeing upside stemming from its business jet portfolio. Next up, Guggenheim downgrading Fox to neutral with a $41 price target, expecting a deceleration in advertising revenue. And finally, Citigroup upgrading CSX to a buy, highlighting multiple tailwinds stemming from easing supply constraints. Their stock is positive by almost 2% at 32.39. Coming up, the big banks announcing their big payout plans. That conversation is up next with Crossmark's Bob Dobb and BlackRock's Tony DeSpirito. 4 minutes away from that cash open. Equities into Tuesday at a record. We look to advance. We're up 4 points, up by about 0.1%. From New York, this is Bloomberg.
Markets never sleep, so stay connected. with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 24 seconds away from the opening battle in New York City this morning. Good morning. Three-day winning streak coming into Tuesday, record highs, and looking to add some weight to the S&P 500. Up about 5 points, we advanced a little more than a tenth of 1% on the S&P to 42.85. On a Russell, up by 0.4%. We lagged just a little bit on a NASDAQ. That's the opening bell. Switch up the board and get to the bond market. 10-year yields, what a range we saw last week. From 135 through 150 this morning. Just south of 150 at 149.68. Yields are higher by a couple of basis points. So the FX market, a clean trend in G10. The dollar stronger. Euro dollar 118.90. Euro dollar down a third of 1%. And WTI crude advancing 0.8 of 1%. A lift to 73.50 on WTI crude. That's the cross-asset story. Let's get to the market desk and get you some movers. Here's Abby.
John, well, we have opened on the S&P 500 with yet another record high, as you were pointing out. Let's take a look at what is helping. Starting out with Facebook, shares are popping slightly higher after moving slightly lower earlier, but net investors seem to be pleased by the fact that the stock is higher after they won a ruling that dismissed antitrust suit from the U.S. and states. The judge saying that the FTC complaint was too vague. So over the last 2 days, you can really see the move higher. As for Boeing, you were talking earlier about United Airlines, 270 jet order from both Boeing and Airbus, the largest in U.S. history, 200 737 MAXs from Boeing, so those shares are popping higher. General Electric is also higher on related news, plus the fact that Goldman has named it a top idea, and then Spirit Aerosystems, 5% of their revenue from the SPLC function in the Bloomberg terminal does come from both Boeing and Airbus. And then finally, taking a look at the big banks, Morgan Stanley and Goldman Sachs really soaring. This on the news that they are really boosting their payouts. Morgan Stanley doubling its quarterly dividend, Goldman raising it by 60%. JP Morgan has raised their quarterly dividend by 10 cents. Citigroup is maintaining, so you can see the effect really weighting toward Morgan Stanley and Goldman Sachs on that payout news, John.
See it on the S&P as well. Abby, thank you. About a minute and 45 seconds into the session, we advance almost 0.2 of 1%. Another record high, a fourth day of gains on the cards on the S&P 500. Leading the way, energy up 0.9 of 1%, and the financials up by 0.87% as the big banks announced distribution plans after getting the green light from the Fed last week. JP Morgan CEO Jamie Dimon writing in a statement the following: the Federal Reserve's hypothetical stress test once again showed that banks continue to have strong capital levels and could withstand an extreme outcome while continuing to support the broader economy. With more is Kaylee Lyons.
Hey, John, well, step one was pass those stress tests and get those restrictions on payouts lifted. Step two is return capital to shareholders, and that is exactly what the big banks are doing. Morgan Stanley really the standout here, doubling its dividend to 70 cents a share and announcing a $12 billion share buyback. The CEO, James Gorman, saying they have an embarrassment of riches because the bank has such a large capital buffer. Wells Fargo also doubled its quarterly payment, of course, from a low base of only 10 cents. And then Goldman, JP Morgan, and Bank of America all raised their payouts too, as Abigail said. The outlier, though, is Citigroup, which made no changes, holding the dividend steady at 51 cents a share, where it's been for about 2 years. And Citi aside, of course, investors are about to reap greater rewards for holding these stocks. Of course, they already have been because COVID-related restrictions on payouts had started to lift in the first quarter. And in that period, these 6 banks returned $23 billion to shareholders, JP Morgan really leading the way at $6.5 billion. But the question is to what extent bank stocks will actually benefit from these updated capital distribution announcements. The sell side viewing the plans as broadly supported for the banks, but bank stocks are already up about 30% on the year thus far, so a lot of this may already have been priced in. They have lost a little bit of ground relative to growth stocks like technology in recent months, so we'll see if they can reclaim some of that leadership, especially as we head into their quarterly results in about 2 weeks' time, John.
Kaylee Lyons on the latest. Kaylee, thank you. BMO weighing in on all of this. They're raising concerns about pricey bank valuations. They write the following: following their strong recovery since spring 2020, banks and specialty lenders have re-rated appropriately. It's time to take profits. Let's get another view on that. Let's get two. Bob Dollar, Crossmark Global Investments, and Tony DeSpirito of BlackRock join us now. Bob, good to see you, sir. Let's start with you. Do you agree with BMO that following their strong recovery since spring 2020, it's time to take profits? on banks?
I don't think so. I mean, if you think the economy is going back in the toilet, I guess you'd want to sell the banks. But don't forget, John, how strong these banks were going into the pandemic. Of course, then they over-reserved, got to reverse some of that and put them back in the earnings stream. I think they've done amazingly well in their earnings despite very low interest rates. We get some uptick in rates, decent economy, which looks to be in the offing. I think the banks are a good place to be.
Tony, do you agree?
I do. As you know, I like the banks here. I think the valuations are still very attractive. And if you look amongst cyclical sectors, compare them to industrials, for example, they both benefit from a rising economy, yet financials are way more attractively priced. I also think you have to look at the interest rate environment. We're still pegged at zero. As interest rates begin to normalize, banks will be a huge beneficiary of that in terms of their earnings power growing. And then finally, I think when you think about inflation, what do you think about as risks for the market? And certainly inflation is one of the risks that I think about. And the banking sector is one of the few areas of the economy that benefit from rising rates and rising inflation. And so I think that's a nice hedge to other areas of your portfolio.
Let's get to the individual names 5 minutes into the session. We've heard from the likes of Morgan Stanley, from Goldman, from JP Morgan, from Citi. Morgan Stanley, as Abby pointed out, doubling the dividend. That's up by more than 3%. Goldman Sachs lifting its dividend quarterly payout by 60%. We're up by 1.9%. Got JP Morgan, they go from 90 cents to $1. Citigroup do nada. And it's largely reflected in the price action this morning. I just want to understand from your perspective, Tony, the dividend yield on these names now. Can you just give me some context, better perspective here, some clarity? Just how big is that yield at the moment?
Yeah, this is a great sector for yield investors. First of all, the yield is high, particularly when you think about total yield, meaning both the dividend yield and the buyback yield. That gets you up to high single digits in most cases. That's a really big deal, particularly in this low interest rate environment where the 10-year Treasury is at 1.5%, and even high yield is just earning over 4%. So I think that's really, really positive. The other thing that's important is sustainability and the ability to grow the dividends. And when we look at our quality scoring metrics, the banks have continued to move up the scale on quality. They're safer and sounder than they've ever been. I think you look at the stress tests, those have become a lot less stressful and way more predictable. And it's just a sign that the banks are way higher quality. So you're getting good dividend yield, and I think that's a well-protected dividend yield. Even in the pandemic, you saw that most banks were able to hold the line on dividend yield despite a very tough economy.
Bob Dole, it begs the question then, do I need the Treasury market to perform here in a way that is advantageous to the returns of the bank sector? I've heard so many people, Bob, say that for bank equities to do well here, for bank equities to continue this run, we need yields higher, we need a steeper curve.
John, that to me would be icing on the cake. I agree with what Tony has just been talking about. The quality, the total return, including the buyback, all of that is pretty attractive regardless of where the curve is at the moment. What the question you asked, again, would I think just add fuel to the good fire for these companies that do even better and the stocks to outperform.
It has been a good fire, up by around about 30% year to date on a bank equities. Pleased to say that Bob Dole and Tony DeSpirito will be sticking with us. All-time highs in this equity market, potentially a 4th straight day of gains with your movers. Here's Abby.
John, speaking of a good fire, let's take a look at some of the Reddit stocks, because we, of course, have this movable feast. Some of the older ones, especially GameStop, which is now out of the Russell 2000 into the Russell 1000, because that's how much it has climbed. It's down just a little bit today, but remember, this was a $4 stock a year ago. Now it is a $209 stock. The new names, SoFi Technologies, up 5%, and then Marin Software, up 17%, now up 6 days, gaining 473% over those 4 days. Not surprisingly, it is a $9 stock. And then Accela Technologies, a new one on the band, an $87 billion market cap, so $1,000,000 market cap, I should say. So a really micro cap, but up 63% on the day. As for Virgin Galactic, it, of course, over the last month or so, has been up in a huge way, up nearly 300%. A part of that, the flight to space, but it does have a 23% short interest. So today, some of those Reddit traders not paying as much love to Virgin Galactic, John.
Abby, thank you. A couple of the names to watch then, in and around the opening bell. About 9 minutes into the session, your equity market advancing 0.2%, a 4th straight day of gains on the S&P 500. and another record high, another all-time high. As we close in on 4,300 on the S&P, keep this in mind, year-end median forecast of all the strategists that we survey, year-end your median, 4,300 on the S&P 500. And here we are, slap bang in the middle of 2021. More still to come from New York. This is Bloomberg.
This morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Most of the good news has been discounted. I mean, we know things are, going very strongly right now, but then we're also peaking in terms of rate of change. Overall, we're, a little bit cautious coming into the second half of the year, where I think the market is going to be choppier.
US equities continuing to hit fresh record highs. Morgan Stanley's Mike Wilson weighing in on the rally, saying the following: the inflows of money are still so good. The money does not leave the market. It just looks for another place to go. Mike Wilson from Morgan Stanley there on this record-breaking rally. With more, here's Candy Lyons.
Well, we're almost at the end of the first half, John, and a stellar first half it has been for this equity market. Actually, the second best first half the S&P 500 has had, going all the way back to 1998, up more than 14% over the first 6 months of the year, and of course at a record high today. The question is how long the gains can actually last and what the second half is going to look like. Now, history may be on the side of the bulls, given that when you look back at the last 27 years when gains in equities equities were this strong through the first 6 months of the year, 3/4 of the time they continued to climb higher through year end. But there also may be some cautious signs bubbling beneath the surface, John. One of them being breadth is not great. The S&P, as it has risen to records, has seen a large chunk of the index not participating. Less than half of its members are trading above their 50-day moving averages and less than 3/4 above their 100-day moving averages, a share that is significantly smaller than it was earlier this year. And that may be a reason why investors are looking for downside protection here. The SIBO Skew Index, which tracks how expensive it is to hedge against tail risk, is sitting at an all-time high, well above the level seen at the height of the coronavirus market meltdown, at the height of the financial crisis, and the dot-com bubble. So that reveals a sense of fear on the part of market participants who may be a bit jittery with valuations still elevated relative to history, earnings starting to peak out in terms of growth, and then, of course, risks like higher taxes and regulation coming down the pike, John.
Katie, thank you. For those reasons, then, do you start to look abroad? BlackRock's Wei Li identifying opportunities internationally, saying the following: the US has led the developed world's economic restart, but its growth looks to be peaking as the restart broadens out. We see the potential for other developed markets, such as Europe and Japan, to pick up the baton and benefit more from the restart trade. I want to bring back in Crossmark's Bob Dole and BlackRock's Tony DeSpirito. Tony, the issue I have with this is we conflate economic growth with what's happening in markets. And I do wonder, yes, the US economy has led the restart, but the market hasn't. The Euro Stoxx 50 is up by almost 16%, the S&P 500 up a little more than 14%. And that Europe versus US trade is less clear when you start to look at the performance of the first half, Tony. What's your take on it?
Look, I think there's a lot to like about both markets. I think longer term, what I see that I really like about the U.S. is there's a lot of high quality compounders in the U.S. So U.S. companies on average earn higher returns on equity. On average, they grow faster and therefore deserve higher multiples. And so I think from a longer term perspective, I really like the U.S. quite a bit. From a tactical perspective, I do see opportunities outside the U.S. increasingly. The U.S. economy has certainly been the strongest right here out of the gate. We've had a very powerful vaccination effort, plus very powerful policy support, both fiscal and monetary. And we've led the way on all three dimensions. I do think there's a catch-up trade to be had, particularly in Europe.
What about you, Bob?
I agree. That is to say, long-term, the U.S., higher quality, more growth, better returns, but there's a catch-up trade, to use Tony's phrase, coming, assuming economic growth outside the U.S. picks up. The U.S. has been so dominant from a growth standpoint, it's no wonder capital has flowed in this direction. But I think as global growth picks up, non-U.S. is likely to do a bit better. Remember, the United States is the most defensive big market in the world. That is, non-U.S. markets are more cyclical, should benefit when that economic tailwind shows up.
But when you say catch-up trade, what do you mean? Catch-up over what time period?
The next 6 to 12 months, my guess is international...
Now, Bob, forgive me, I'll clarify. Forgive me, just let me jump in. When we say catch-up, we're catching up on what? Over what period did we lag that we're catching up on?
Well, certainly not Europe year to date, but globally year to date, and then you look really since the pandemic low, and I think there's more to be had. Then you look at the last decade, most particularly, and the U.S. has just clearly outshined almost everything overseas. That's the gap I'm talking about, because we've had better earnings growth, and of course our valuations have moved up to appropriate relative to the rest of the world levels.
Well, that's Tony's argument too, isn't it? That the valuation, the richness of the valuations in the US versus the rest of the world is justified. Bob, just to build on this, because it's an important debate, what justifies the catch-up in the valuations and the lagged performance over the last 10 years or so, beyond just the reopening and the momentum that you could see through the year ahead?
Well, earnings move stocks. We know that. And if we get that better economic momentum, and that's my supposition, then we will get better earnings growth outside the U.S., and that will give us the so-called catch-up trade. But at the end of that, assuming you can time things, you come back to the U.S. because the longer-term growth is stronger.
Yeah, and timing things is really tremendously difficult. Getting things right, looking out a year out, is really, really hard too. And when we started this year and we had calls north of 4,000, those calls started to come through in late October, late November, and a lot of people thought it was crazy. The median year-end forecast right now is 4,300. And that's conservative because at the moment, we're at 42.98. At the high end, you've got 4,600. That's Jonathan Golliver, Credit Suisse. At the low end, 3,800. That's Savita Subramaniam and the team over at Bank of America. This 4,300 year-end price target, Tony, we're there right now. What do you think has surprised you, just in terms of positive surprises through the year so far?
Well, I don't know that it's a surprise, but economic growth has delivered. I think this is going to be a very fast recovery, which is going to really differentiate what's going on now versus the economy we saw coming out of the global financial crisis, which was one of the slower but more prolonged recoveries. I think this is going to be a very fast recovery, but we still have a ways to go. Unemployment's at 5.8% right now. And so I think that's really the positive driver. You combine that with good policy support, and that's what's causing the market to rise and will continue to do so. So I'm still very bullish on equities.
Yeah, Bob, just finally to you, because it's important. Do you think we're still underestimating economic momentum? This conversation about deceleration, underestimating earnings somehow? Or is this it, 4,300, and it's going to be a struggle from here on out?
If the past is prologue, and often it is, we are estimating. Every time you turn around, numbers are moving up. Now, the consensus has earnings up in the second quarter, 60%, 20% in the third quarter, and 15% in the fourth. So that deceleration is noticeable. Stocks love accelerating momentum. So could we get some choppiness at some point? I suspect so. But to your question, economic growth, hard with all this money sloshing around and interest rates this low, not to think growth will be strong. And if Joe Biden gets his way, we're going to spend some more money, and that more fuel for the fire, to go back to that phrase.
Some more money could be trillions, eh, Bob? Bob, it's good to see you. Two of the sharpest minds on Wall Street. Bob Dole, Tony DeSpirito. Thank you, gents. Your equity market, 42.98 on the S&P 500. We did almost kiss 4,300 at 42.99, and I'll go over those numbers again. 4,300 is your median year-end forecast of all the strategists that we survey here at Bloomberg. At the high end, 4,600 over at Credit Suisse, and at the low end, Savita Subramaniam and the team over at Bank of America at 3,800. Your equity market advancing for a fourth straight session. Let's get you some sector price action and touch base with our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. 10 of the 11 main industry groups in the S&P 500 are higher in early trading. Communication services, where you find Google's owner Alphabet, Facebook, and a bunch of other companies, are the exception here. Economically sensitive areas of the market are, for the most part, leading the way. You look at the commodity producers, energy, raw materials at the forefront of the gains, industrial stocks higher. You know, financial shares, though, not doing so well in relative terms, because we're seeing some of the biggest banks pull back, even in the wake of those dividend and buyback announcements late yesterday that followed the results of the Federal Reserve stress test. Citigroup decided to keep its payouts the same. Its shares are down. So are Wells Fargo and Bank of America, JP Morgan higher. But we're seeing the biggest gains in the likes of Goldman Sachs and Morgan Stanley, which are actually part of what they call the Diversified Financials Index within the S&P 500. We should note, though, the banks this year, second best performers out of the 24 industry groups on the second level of the S&P. Only energy has done better.
Dave Wilson, thank you very much. Went over that sector there, the bank sector on the S&P 500, a gain of 27, 28, 29, pushing 30%. Let's look at the single names in the early part of trading this morning, about 22 minutes into the session. Morgan Stanley, as Abby pointed out earlier, and just briefly there with Dave Wilson, doubling the dividend. That stock up by 2.9%. Goldman Sachs increasing the dividend by 60%. We're up 0.9% there. JP Morgan going from 90 cents to $1, advancing about 0.5% there. And Citigroup, that's it. That's the silence. That's what you got. Not a lot. 70.56. We're down by a little more than 1% on Citi in the early part of trading. They are the bank stocks. Coming up, the market moving events you need to be watching. That'll be next in our trading diary from New York City. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
25 minutes into the session, a record on the Nasdaq. We advanced a little more than 0.1%. A record on the S&P 500. We advanced by 0.16%, and a fourth straight day of gains on the S&P. 42.97, just short of 4,300 on the S&P 500. That's the price action. Let's get to the trading diary. What you need to be watching through the rest of this week. Consumer confidence coming at the top of the hour. President Biden heading to Wisconsin, promoting his infrastructure plan a little bit later. Plus the Economic Forum continuing from Brussels, and finally rounding out the week with a payrolls report on Friday. Your estimate, 700K. Your high, a little bit above 1 million. Your low estimate in our survey, something in and around 400,000. One thing missing from that, a football game taking place in around about 2 hours and 4 minutes time. It's England-Germany. You know what I'll be doing later this afternoon now? I'll be watching a football from New York City. For our audience worldwide, this was the countdown to the Open. Thank you for choosing Bloomberg. This is Bloomberg TV.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of